Welcome to the European Market Open, everyone. A minute to go until the start of cash equity trading. I'm Francine Lacqua in London with Tom McKenzie.
And here are your top stories. Waiting on jobs. Asian equities and US futures edge lower after a key inflation gauge comes in softer than forecast. The next clue on the health of the US economy, non-farm payrolls. Crisis in Cape Town. South African President Cyril Ramaphosa weighs resignation amid corruption allegations. The rand takes its worst tumble in 6 years. Plus, bank cuts, lenders start slashing bonuses and jobs. The chair of Credit Suisse exclusively tells Bloomberg that outflows have stopped from the embattled lender.
So, Tom, let's take a look at the futures. We'll have plenty more from some great interviews. We're also speaking to the South African finance minister a little bit later on. Now, DAX futures actually pretty much unchanged, similar for the FTSE 100 futures. Again, we look towards next week, and it's all about, well, data from the U.S. today, and then what the Fed does or doesn't do.
Yeah, something of a holding pattern today, given the build-up to the non-farm payrolls. The expectation, the estimates are you're going to get a print of 200,000, so slightly softer than the month of October when the number came in around 260,000. Of course, the participation rate will be in focus. Wages and wage growth, we know that that continues to be well above the levels pre-pandemic. So all of that feeding in to the expectations as we build up to that number. 1:30 UK time. The FTSE 100 currently down 0.2%. The Spanish IBEX off by 22 points. Over in Germany, just a loss of about 0.1%. Over in France, the CAC 40 lower by 0.4%. Let's switch it over and have a look at the cross-asset board then. Some losses yesterday on Wall Street, but a profit-taking after the previous day's rally. Currently, futures pointing lower by 0.2%. Euro-dollar at 105. 105 for euro-dollar, range-bound, but you have some upside given the softness in the US dollar. And the US 10-year, the benchmark at 352, just a move of 2 basis points. But just in the context of the last 3 days, you have seen those yields come off by about 20 basis points on the benchmark across the curve, but the benchmark about 20 basis points as money moved back into US Treasuries. Brent trading at $87 a barrel. That is a gain of 0.4%. It's OPEC Plus. That's in focus for us this weekend. Whether or not they adjust to this higher price, are they comfortable with the price as it is, or are they looking to cut, Francine?
Now, when you look at the stocks on the move or the sectors on the move, I can't say I'm seeing a lot of green. There's one indices, or there's one sector that's gaining 0.1%, and that's real estate. Everything else is down, but it's not huge losses, Tom. So the worst performing sector at the moment is energy and basic resources, down 0.9%, and the other ones are pretty much range bound between -0.1% and -0.3%. So as Tom was saying, we're pretty much in a holding pattern for now. Now let's get over to the Bloomberg and Live managing editor. He's the one and only Mark Cudmore. Of course, Mark is looking at U.S. payrolls and recession risks.
Yes, good morning, Fran. That's what I have to focus on today. It is the big macro data point. So this chart, the white line is the 12-month moving average of the headline jobs print. For the last year, it's coming in at 442. That's the average over the past year. So more than 5 million jobs have been added over the past year. The most recent print was 261K. Today, we're expecting plus 200K. So this chart, nice yellow line there is the zero marker. These red bars you can just about see are all the recessions in the past 50 years. So a very small one there for the pandemic, back to the crisis, 1, 2, 3, 4, 5, 6, 7, 8 recessions. With a 100% hit ratio and no false signals, this 12-month moving average of jobs has turned negative in every single recession. The most narrowly caught one was back at the start of the 80s, where we only just went negative. What that means is in every single recession in the past 50 years, we have seen net over a 12-month period job losses in the US. That's versus more than 5 million given over the past year. So there's two conclusions. One, we're nowhere close to a recession in the US. And if we are going to have a recession in the US, we can expect very deep job losses next year, or we have to be in a scenario we've never seen before. I'm afraid I'm in the former camp. We're going to get a recession in 2023, and I think it's going to come with this number going deeply negative over the next year.
Jobs picture ahead of non-farm payrolls. Interesting that some of the manufacturing data came in softer as well. The first contraction, I believe, since May of 2020 in terms of US manufacturing. Mark Cudmore, of course, Bloomberg's MLive managing editor. Thank you. Now, risk-off mood in the markets then as traders look ahead to that US jobs report for clues on the Fed's rate path. Bets on the peak have now dropped below 4.9%. That is according to swap markets. Joining us now is Magdalena Poland, lead economist for PGIM. Magdalena, good morning. Thank you for joining us. And I want to start on the softness in some of this US data that's come through, whether it's the services PCE indicator or indeed that manufacturing print, and where that leaves your view on the fragility of this US economy.
Good morning. Yes, this is some of the most watched data and currently very scrutinized to assess where the US economy is heading, and very importantly, where the Fed is heading, because that Fed and the US monetary and macro cycle remains absolutely crucial to the outlook for the global markets, the global central banks, and ultimately the global economy. So watching this very carefully, because we are at the moment of an inflection. We have seen a change in the rhetoric coming from the Fed and from the Chairman Powell recently. There's been some toning down of the hawkish tones, and that outlook remains very important, that the turnaround remains very important for where the dollar will be heading, what the global financing conditions will be, what kind of risks we can expect. So not only the importance for the Fed, but for us as emerging market investors, this remains a very, very closely watched activity. Yeah. And it remains a little bit puzzling. You just said that earlier that the data so far does not really suggest that there is a deep recession risk. But at the same time, we all know that that slowdown may very much appear. Therefore, looking at every single print remains very important to gauging those risks, both for the US, for the Fed, and for the emerging markets.
But Magdalena, I was looking at a PGIM, I think, fixed income note, really expecting the yield curve inversion in the U.S. to get much deeper. So what does that signal, and how do you know, what does it mean for the economy? Is there really a chance that it avoids a recession?
So we do see the risk that there will be indeed a slowdown in the U.S. economy, and but assessing that extent is probably much more difficult. And just as your colleague was saying before, gauging by the past experience with recessions, this could be indeed, let's say, I don't want to use the word classical, but the usual size of the U.S. slowdown. But the data so far has been confusing, not only in the U.S., but also in the other countries that we look at. There is a similar pattern of a confusing data that points in various directions. And that's why, even though we do expect a slowdown in the U.S. economy, but also globally, the extent of that slowdown still remains uncertain, given that divergence between some of the survey data showing both very good mood in the U.S. economy, but also very depressed mood in the U.S. economy. And then also in the European data, we see the same. We see a depressed PMI prints and weakness in some of the soft data, but actually fairly strong data in some of the sectors or some of the European economies. So that's why we look at every single print so carefully to assess the potential for that slowdown.
Yeah, passing this data, as you say, incredibly challenging. We want to make the pivot to EM, but let me just push you a little bit on the jobs picture in the US. We have non-farm payrolls coming out later today. We've seen the wages still, in terms of wage growth on a monthly basis, well above pre-pandemic levels. We know that participation rate is a challenge. We know job openings remain still relatively elevated. Are you seeing any signs of slack in this jobs market?
I think that also is a testimony to the fact that it's not just the cyclical picture we're looking at, but we're also looking at the structural picture, structural change, and the change in the participation rate, changing the just availability of people pushes that wage growth higher. So far, I think we've seen a little bit of a softening in the U.S. data, or let's say less of a tightening in the U.S. job market data. But I think we still are going through that post-pandemic change, and then also probably some demographic change affecting that U.S. market. And again, very, very closely watch indicator, because we need to distinguish between the cyclical and structural.
Magdalena, is there a concern that actually markets keep on mispricing how aggressive the Fed needs to be to get inflation under control? I know that they won't hike as aggressively as expected, but just to get near 2%, maybe we're underestimating where they need to end up.
Absolutely. So I think that concern has been actually more pronounced until recently, when the market was looking for the terminal Fed rate. But both a little bit of, as you just said, some slowdown or maybe some moderation in the U.S. sequential data, especially on price growth, and then the tone change from the U.S. Fed has probably helped the market reach the end of that, or the pricing of the end of that cycle. So currently, I think we are in a bit more of a holding pattern for these expectations. And obviously, risks can go both ways. But so far, it seems that we are in a more of a steady state for expectations, which also then helps us look a bit more optimistically on the rest of the world and those markets that depend on the Fed.
Yeah, well, let's tie this to EM then. What does a step down to 50 basis points in December? What does a terminal rate of around 5% for longer? What does that mean for EM?
So just a shift in expectations in market pricing was already a fairly positive signal for emerging markets and for the global economy, because it does, it helps to anchor the expectations of the market. So that's a very welcome development for any EM central banker, but also for investors in the EM. The second is the change in the view on the US dollar, because it removes that pressure, that relentless pressure that we've seen on every single currency that is not the US dollar, or in a country that has, let's say, hiked aggressively like Brazil. So that shift removes that tail risk that funding conditions will be tightening even further. And especially for those countries that do have larger funding needs, a lot of emerging markets, but also the developed markets, have suffered that shock of higher energy costs and narrowing of their trading surpluses. Even Germany or the Eurozone is seeing that. So that anchoring of the US Fed expectations gives them a little bit of a breathing space to ease on their own needs to tighten, and also on those risks to external funding.
Magdalena, thank you so much, as always, for your great insight. Magdalena Poland, their lead economist for PGIM. Now, coming up, the chair of Credit Suisse tells us that outflows have stopped from the embattled lender. More from our exclusive interview with Axel Lehmann. That's coming up next, and this is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Welcome back to the Open. We are 14 minutes into the European trading day. Happy Friday. Losses of 0.5% across the benchmark. Over in Italy, the FTSE MIB down by 0.3%.
Now, tomorrow marks 6 weeks since Italy's new government took power, a coalition of the right, including Prime Minister Giorgia Meloni's far-right Brothers of Italy party. In that time, it has already clashed with neighboring France over migrants and faced questions over its commitment to supporting Ukraine after the Russian invasion. Now, all of this as the country's economy continues its lackluster performance in the face of inflation pressures and high energy prices. Now, to talk about Italy, but talk also about the oil cap, we're joined from Rome, Med Forum, by the Italian Foreign Minister and Deputy Prime Minister Antonio Tajani. Thank you so much, Mr. Tajani, for joining us. Deputy Prime Minister, when you look at the oil cap, what kind of level could Italy get behind? What's the optimal level of the price cap for Italy?
Good morning, everybody. Hello, thank you for hosting me today in this very important mission in the UK. But I think we are working hard with the new government for more Italy in the Mediterranean region. Today we are here with a lot of ministers coming from Africa, from Europe, because for us it's crucial to achieve good results on immigration, because it's one of the most important problems for us, against terrorism in the sub-Sahel region. And also we want to improve the trade in this region. We are ready also for organizing mission for growth to Africa, for organized joint ventures between our companies and African companies, because African growth is crucial for us, and we need to work against climate change altogether, against poverty, in favor of health, and against terrorism. For this meeting is very important for us. It's very important for the Mediterranean Sea. We will work all together on this.
Foreign Minister, to the here and now, though, and just to reiterate Francine's question, what is the optimal price cap when it comes to Russian oil? We're hearing $60 US. Is that in line with what the Italian government is pushing for?
But we need to be free from the Russian gas. We want to buy gas from African countries. There is a good agreement with Algeria, first of all. But we need to have a price cap because we are against speculation. We are working hard at the European level for achieving an agreement. The first proposal bad for us. I want to be optimistic for achieve good results because the stock exchange in London, the gas stock exchange in Amsterdam is not working very well. For this, we want to help our companies, our families. For this, we need a price cap.
Of course.
But this is among a strategy.
But, Deputy Prime Minister, is there a figure that you're targeting? Is there a figure that Italy would get behind? Do you think we'll get a price cap? And is $60 what Italy wants?
For us, the energy is a key point. We need we are working hard in this direction, but we need to do at European level, because if we are alone, it's impossible to achieve good results. It's one of the most important for Europe to have a strategy on the price on energy, but also we need to strengthen the internal market on energy. We need to have more different sources of energy. The price is in this moment there is a speculation for this, but the situation today is much better than 1 month ago. But we need to be very prudent, very active in this sector, because if we want to beat at political level Russia, we need to have good prices for gas and for energy in Europe.
Okay, we were hoping it was going to be a third time lucky on the question of the cap for Russian oil. So let's move it on from oil to gas then. How confident are you that the EU can agree a cap on Russian gas?
But Russia is pushing hard, and we need to change our strategy. We need to have more renewables. I think also nuclear energy is important. We need to to work hard in this sector. Of course, we need to pave the way for nuclear in the next 10 years. Sorry, in the next 10 years, it is important to do it because renewables are very, very important for this. We are working also with other countries. Hydrogen, for example, is another important point for us. Also during the meeting with the Minister of Foreign Affairs, we are talking on this.
All right, Mr. Tajani, thank you so much. We hope to have an extended interview where we can get quite a lot of depth into what Italy wants exactly. That was the Italian Foreign Minister and Deputy Prime Minister Antonio Tajani. Now, the chairman of Credit Suisse says the bank has mostly stemmed the huge outflows of client assets that have helped send the shares to a record low. Well, Axel Lehmann spoke to us earlier.
Of course, that's never easy. We have quite a lot of roughly some 10 key investors. They are long-time investors. They are not pleased where the share price is, of course. But, you know, they welcome our plan to transform the company. They have a high belief in the credibility of the management team. So they are standing by. But, you know, they are somewhat impatient. They want to see the change. They want to see us executing. And exactly that's what we are doing.
So what kind of conversations are you having with them? Are you confident, first of all, that the share price after the rights offer will go up?
Look, we are at 0.2 or so price to book. All our peer companies in our sector are roughly hovering around book, slightly below, slightly above. There's no reason that we cannot, catch up and go back to that level. Obviously, I cannot predict when that is happening, but the upside potential is huge.
How much? So what I'm trying to understand, what a lot of people are trying to understand is that every day there's bad news on Credit Suisse, and you see staff leaving, you see investors unpleased. Like, how do you recapture that narrative?
Look, we had, beginning of the month, we had that social media storm that had a huge impact on, interestingly, not on the institutional side. Professional investors understood there was a lot of rumor spelling, but on the retail and wealth management side. So we reached out. We reached out to 8,000 wealth management clients. They are covering roughly 80% of the assets under management. We reached out to more than 24,000 clients on our core market. So we intensified the dialogue. Just to make sure they understand where we are and just to make sure we maintain the contact. But
what was the feedback like? So if I'm a new client, if I'm an old client, why would I put 100 million with all of the uncertainty surrounding Credit Suisse?
No, the feedback is quite astonishing. The clients still like us. They continue to do business with us. So we had basically very few clients really leaving. They might have, in light of those rumors, withdraw, some money from us. But I'm confident. I have a lot of personal discussions with clients. I know from regional management, that money, when we do well, will come back, at least to a significant part.
When do you think the outflows will stop?
The outflows basically have stopped. What we saw is 2-3 weeks in October, boom. And since then, flattening out, they have stopped. It's gradually coming back, in particular in Switzerland.
I mean, a number of analysts are also talking about, what could happen to Credit Suisse. So are you evaluating other strategic options, given the share price dilution and the market reaction to your announcement?
Look, when you step back, we do a capital increase now. In 4 working days, we will have 4 billion with a CET1 ratio of 14% or close to 14%. That is top quartile in the industry. So it's a really strong balance sheet to carry through that transformation we go. So we execute our plan.
But why do shareholders not believe you? Why does the share price keep on falling?
No, I think the shareholders, core shareholders, they believe us. And they will exercise also their rights. The share price is falling, yeah, of course. The rights issues are traded. The market tries to drive down the price, which is logic, but it's fully underwritten, will be done. So the volatility on the share price will continue until we are through that, capital increase. Then I think it will somewhat, stabilize and probably, we just move on from there. So,
Chairman, no plan B. Is there a plan B? If somebody came today and said, look, I offer you to merge 10 Swiss francs. Or share.
Look, as chairman, you need always to consider all. When somebody comes and would do that, of course, you need to take a look. But, I tell you, when you are where we are, with the historically low on the share price, with a great management team, with a plan that is convincing the market, and the market, our shareholders believe it. It takes time to execute. We can capture that value, and we will do so.
How difficult is it to retain staff?
It is obviously a challenge. Now we have so many people, 50,000. I think they are very much under pressure, very committed. We have still excellent people, and the good thing, we continue to attract and hire, I think, very, very strong caliber individuals. But it's something to watch closely, clearly.
But how do you attract them? So again, because the franchise is tainted, do you have to have difficult conversations with people?
It's interesting. Also, when I look to people we attracted at the board or in the executive committee, they see it's a great franchise, a franchise that is a little bit hammered, but they see the opportunity, they see the potential, and they think that is what attracting new talent.
But the worry, I guess, is that if you have Credit Suisse on your CV, does it make you then less applicable afterwards? Are these conversations that you have with people, or it's not a problem?
No. Look, we should not forget Credit Suisse is one of the best brands you can have. It's not only in Switzerland, but you go to Asia, you go to Latin America. I mean, it's a super brand and such a rich history. And in every time in life, we have ups and downs. Yes, we are not in the best shape, but we are getting back, and that is what people see, and that's what they believe.
So when are you expecting inflows to increase? We talked a little bit about the outflows and when you're expecting them to stop. How do you attract new clients?
No, I said I already see now. Anecdotally, when I speak to clients, I know, that there will be inflows. We already see it partially happening. So we have plans to continue to reach out to clients. It might take a little bit of time, but it will, it will come back and we'll go back to normal. I think we just go now through a little bit that storm during the capital increase. When we are done, we are done, and then you start to work step by step. No rush, step by step, executing a plan, and then we are going back on track.
That was Axel Lehmann, the chairman of Credit Suisse, speaking to us earlier. I have to say, he had, really good energy. He wasn't hiding or shying away from it.
He was really frank, wasn't he?
He was quite frank, and he's saying, look, it's a tough time, but we're going to push through, and he's quite confident because of the franchise, he'll get better.
Yeah, but the volatility, he says, until that capital raise is complete. And currently, the stock is trading at 267, so it's a little move down by about 0.8% for Credit Suisse. Don't forget, the capital raise price is 252, so they are not far from that. That is a concern for the underwriters. But again, a very frank interview with Francine. Let's check on one of the other stocks as well. Renault is a story in focus for us today. They've made some progress in terms of getting the union support, at least most unions, on board for this split of the business, the EVs and the gasoline or the combustion engine part of the business. But no, on the back of that, still down 2% on the back of that news. Galp Energy, a double upgrade from JP Morgan for Portugal's biggest oil and gas provider, currently up 1% on the back of that. Coming up, talking of oil and gas, OPEC and its allies are increasingly expected to hold production steady when the group meet on Sunday. We're going to get the details and a preview next. This is Bloomberg.
Is the chance of humankind to really understand itself. How much of that is true? How confident? Did you actually overachieve? Did you, back then realize that we would be using AI in many different jobs? Was it slower or faster than you thought at the time?
I think if I had a 35 or 40 year prediction task, I would have been more or less on track as to where we are today, but I would have predicted steady linear increase over time. But instead, the field had very minimal improvements until the last 5 or 10 years. Then it really took off. I think we ended up in the right place, but I was very wrong about the trajectory. To this date, we still know very little about how the brain works, but these machines are getting ever more powerful. And I feel in some sense, we did end up learning what human intelligence is by learning what it is not. If we exclude all the things machines can do better than us as what makes us unique in our human intelligence, then now we can rule out many, many things, because AI or machine learning has become so good at so many things that what's left must be the key aspects of human intelligence.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. Waiting on jobs, Asian equities and U.S. futures edge lower after a key inflation gauge comes in softer than forecast, while the next clue on the health of the U.S. economy, non-farm payrolls today. Crisis in Cape Town. South African President Cyril Ramaphosa weighs resignation amid corruption allegations, while the rand takes its worst tumble in 6 years. Plus, bank cuts. Lenders start slashing bonuses on jobs. The chair of Credit Suisse also tells us that outflows have stopped from the embattled lender.
The outflows basically have stopped. What we saw is 2-3 weeks in October, boom. And since then, flattening out, they have stopped. It's gradually coming back, in particular in Switzerland.
Tom, if you look at the markets, they care about one thing, U.S. jobs.
200,000, that is the survey. That's the projection in terms of non-farm payrolls compared to 260,000 in October. The number's going to come through around 1:30 p.m. UK time. It's going to build on the picture in terms of just where the Fed is going after, of course, investors and markets picked up a dovish tone from Jay Powell earlier in the week. Then we have the CPI, and then, of course, we have their decision the second week of December. Currently, across the benchmark, you're seeing losses of 0.5%. Interestingly, on the US as well, manufacturing data softening. The first time it's contracted, in fact, since May of 2020, and then you had services PCE coming in softer as well. So a little bit of weakness in the US data. Maybe that's good news for the Fed. The DAX currently off by 29 points, down 0.2%, and the FTSE 100 here in the UK down 0.5%. Basic resources is in focus. Oil, by the way, Bernstein making a call that you get to $100 next year on the reopening of China. Let's switch it over, see how the sectors are shaping up then this Friday. Top of the list, media just gaining 0.3%. Real estate also just clinging on to some gains, but most of these sectors are in the red, led by energy. There, down 1.5%. That's despite the fact that you're looking at a pretty decent week for Brent. WTI back above $80 a barrel, and again, that Bernstein call on $100. Basic resources also off by 1.3%. We have that OPEC Plus meeting, and we're going to be getting into the details of that. That happens this weekend. Francine.
Well, OPEC cut crude production by the most since 2020, fulfilling a new agreement aimed at stabilizing world oil markets. Joining us now is Ole Hansen, head of commodity strategy at Saxo Bank. Thank you, Ole, for joining us. When you look at all of the different constituencies on oil price caps, but also the worry that a lot of the demand will be destroyed if we do see a recession, how difficult is it to forecast the price of oil over the next 12 months?
Well, good morning, Francine. I think you just need to look at the $10 range we had so far this week. Started off with a protest in China, sending it down to $80 Brent, and now we're trying to challenge 90 yesterday, and now we're stuck somewhere in the middle. It just highlights the market, which is still in a great deal of uncertainty in the weeks and months ahead. There's no doubt that looking at the forward curve that we are going through a moment of softness here. We've seen some of the spreads easing. We've even seen contango at the very front. But looking into next year, I'm less doubtful. I'm more doubtful that we'll continue to see these relatively low prices, simply because because the prospect of a recovery in China is most certainly getting more real, and also the impact on the embargo will have an impact on supplies from Russia.
So, Ola, where do you think OPEC Plus is focused at this point? Is it on that contango that you flagged, or is it on the prospects of a reopened China? Do you think they cut this weekend?
I don't think they cut, and that I think we need to see lower prices for that really to happen. They will obviously be quite strong in their wordings, probably weak on action, because I don't think that they see the necessity of that right now, especially given what has emerged from China this week. Because we have to the $10 to $15 sell-off we saw during the past couple of weeks up until Monday, based on China weakness, was unwarranted. We have not seen a drop that justify a drop in the oil price, or a drop in demand that justifies such a big drop. So I think with that in mind, we probably start to move back towards the 90s, and I think OPEC is also aware of that.
Yeah. Ole, if there was a production cut from OPEC Plus, would it actually cause a recession?
That's I don't think that it will be part of what we're already seeing. It will obviously add some additional pressure, especially on the fuel products. And we have seen in recent months that the US is basically supporting Europe by record amounts of exports of oil and fuel products, and that will obviously continue to be a dilemma, which will add upward pressure to prices. But I think it will probably be coming from other areas where if we do see that recession, I don't think the oil price is not going to go dramatically high on that basis, I think.
What is the impact? We know that Europeans are discussing, they're kind of coalescing around $60 a barrel for this Russian cap on oil. We'll see if that is the final number. The Russians are selling oil for cheaper than $60 a barrel. So what is the point of a cap at $60, and what impact will it have on that industry?
It is a very good question. I think it will create a lot of administrative worries and problems. Whether it's actually going to have an impact on Russia's ability to sell its oil, I think remains to be seen. They have managed to circumvent Europe quite a bit in recent months. So I really want to see the details of a deal before getting a clearer picture, because I think it's been very difficult to gauge what the actual impact will be. So I think the jury is still out on the actual impact of such a cap.
But do you think we'll even get a cap? And actually, if there is there a sweet spot for the price cap, even if it doesn't make that much of a difference on what happens to Russian oil?
Well, there might be a cap, but I think at the same time there probably also will be some worries about Russian retaliation if a cap is basically preventing them from selling at prices where they are selling now. As you mentioned, Tom, they're already selling at a steep discount to Brent. So if they start to be forced to sell below their current levels, then obviously that could trigger retaliation. And with that in mind, I think that is also a worry right now for Europe, because we really need to look elsewhere for our oil, and the US is starting to get a bit stressed on their ability to produce and supply that.
Ole, do commodities continue to outperform in 2023?
I think they will still be doing very well, and with the prospect of earning growth still coming down with the economic slowdown, I see a commodity market where we can easily still move higher, even if we potentially hit recessions around the world, because simply the supply side is still challenged to the extent that the prices is likely to remain supported, and that goes especially, I would say, for the metal sector, and it goes also to a certain extent for the energy sector. And if the Fed is struggling to get inflation under control, then obviously precious metals will have a good time next year as well.
Okay, Ole Hansen, head of commodity strategy at Saxo Bank, talking of precious metals. Gold currently at 1,800. It's seen a bit of upside just in the last few weeks, though. For the year, gold is flat. Brent currently trading at $86 a barrel. WTI at 81, just down 0.3%. Coming up, a rude awakening. Yes, Goldman Sachs warns its traders that bonuses will be slashed. Oof. More on that next. This is Bloomberg.
is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together.
Now I would have a much more experience about those who says I love you and then destroy you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci's really teetering on the brink at this stage.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back to the Open. Happy Friday, 41 minutes into the European trading day. Looking ahead to non-farm payrolls, the estimates are for 200,000 additional jobs to be added. Currently, the European equities, the benchmark is down 0.3%. Futures in the US off by between 1/10 and 0.2%.
Now, Goldman Sachs traders are in for a bit of a rude awakening. Bloomberg has learned that the lender warned the executives in the global markets division that its compensation pool will be slashed. The bonus reduction by a low double-digit percentage follows a similar warning from Jefferies, which blamed a volatile year across Wall Street. Now, for more, we're joined by Bloomberg's finance reporter, Tom Metcalf. Tom, good morning. So how big of a surprise is the Goldman news?
I think it's a surprise in that the area that is affecting is the trading unit, the markets division. So, people were expecting big cuts in the investment banking unit, but these are the traders. These have done really well. They've supported the bank. And of course, Goldman is, sort of well known in the street for sort of eat what you kill. If you perform well, you will get bonuses. But what we're hearing is there's going to be sort of cuts to the bonus pool that's sort of in excess of or not reflective of how well these traders have done this year.
So there's the surprise for the traders at Goldman Sachs, but they're not the only ones. This is rippling across the industry, Tom.
Yeah, look, this is the big issue for a lot of bankers out there, and particularly in investment banking, that deal side, the ECM side. But yeah, pretty much every bank, you've had Jefferies this week warning their staff it's going to be a tough bonus season. At Barclays, we're hearing some banks might get zero bonuses. So, across the board, and particularly in investment banking, it is going to be a much tougher bonus season than at least last year.
Tom, what's going on in the UK?
In the UK, particularly on the bonus sort of cap, which has been lifted, it's quite interesting. We got a story out today saying, great that the government did this, but the banks are largely left cold by it. So it's really introducing for them more legal and regulatory issues. This idea that they can now shift away from having a sort of very high fixed salary to sort of compensate for lower bonuses. That restriction is going to be removed, but obviously, if you've already set your bank up for those previous legal restrictions, it's going to be difficult to reverse. So what we're hearing from the industry is, we didn't really ask for this change, and to be honest, it's almost causing us more trouble than it's worth.
Yeah, it needs a lot of reworking of contracts. Tom, if you step back then and more broadly look at this industry, how much of this is about cost cutting? Are there further job cuts to come in kind of the months and quarters ahead? Where is this industry in terms of resizing within this potentially recessionary environment?
Yeah, I think that was the most interesting thing about the Goldman news is, it's the suggestion that, it's basically shareholder driven. You need, they want to see a higher return on equity, and obviously a big chunk of any of these investment banks is sort of bottom line or cost line, at least, is this compensation. So it's being driven by that, and I think in Europe in particular, that grim economic outlook is making people cautious. So it's not just a reflection of the performance this year, it's also looking at, I think we're going to have tough times in the years ahead.
Okay, Bloomberg's finance reporter Tom Metcalf on the bad news when it comes to bonuses. Thank you. Now, US authorities are asking crypto investors and trading firms that work closely with FTX to hand over information on the company and its key figures. That's including the founder, Sam Bankman-Fried. Joining us now is Bloomberg's crypto reporter, Emily Nicol. Emily, what are the questions then that US authorities are trying to find answers to?
So there are several investigations ongoing at the minute. Many of them started even prior to the bankruptcy filing. But the questions that we're hearing that are being asked of companies in crypto, also former employees of the companies involved, are seeking to understand better whether or not FTX was misrepresenting its services or its holdings of customer assets to others in the space. So basically seeking to find if there was any kind of potential incriminating discussions being held or any misrepresentations happening there between both FTX and Alameda, its sister trading platform.
Bankman-Fried, Nicole, has made several public appearances this week. Have we actually learned anything new about what happened at FTX?
We've heard a lot from Sam this week. He's appeared quite a few times in public, much to the dismay of his lawyers, we assume. What he's been saying is that his understanding of how FTX worked was basically flawed. He didn't fully anticipate the risks involved. He wasn't actually thinking much about the risks at all. But much of that was actually evident already in the bankruptcy filings and the comments made from the new FTX CEO, John Ray, who said that he'd never seen such disarray in a public company before. So we're still kind of in the air as to whether or not there was anything potentially criminal happening in FTX. But I assume all of that is still to come, especially with the probes that are coming down the line.
Emily, what are you and the team watching in terms of the fallout from FTX? BlockFi, of course, filing for bankruptcy. Who's next?
So there is one more company that we're expecting that could file for bankruptcy soon. That's what investors and sources are saying, and that is Genesis. It's a lender that is owned by Digital Currency Group, which also owns the Grayscale Bitcoin Trust and news publication CoinDesk. We've been on bankruptcy watch for a while with that. Genesis was warning investors last week that if it didn't raise at least $1 billion in fresh financing, that it may have to seek bankruptcy imminently. Other than that, there are several other companies in the space that now appear to be struggling because of assets locked on FTX. We heard about a small crypto lender earlier this week missing a loan. So until the bankruptcy proceedings go forward, there's still a lot up in the air as to who may be affected. There are creditors with hundreds of millions of dollars stuck, and those names are still private. So until we learn more from the bankruptcy filings, we won't quite know the scale, but it's definitely endemic.
Emily, thanks so much. Emily Nicole there, looking, of course, at crypto for us. Now let's also get straight to the Bloomberg First Word News with Alice Atkins. Hi, Alice.
Hi, Francine. The European Union is closing in on a deal to cap the price of Russian crude oil at $60 a barrel. It's the bloc's latest attempt to clinch an agreement before a Monday deadline. But we're told Poland continues to push harder on the sanctions package before signing off on the price cap. Talks are set to continue. In the US, President Biden says he won't apologize for a new climate and tax law that European leaders say unfairly subsidizes American companies. The row is threatening to overshadow the visit to the US by French President Emmanuel Macron. The EU has said it may take the US to the World Trade Organization over the law known as the Inflation Reduction Act. Blackstone's $69 billion real estate fund for wealthy individuals says it will limit redemptions. It's one of the most dramatic signs of a pullback at the top profit driver for the firm and a chilling indicator for the property sector overall. The news sent Blackstone shares falling as much as 10%, the biggest drop since March. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom?
Alice Atkins, thank you. Coming up, Cyril Ramaphosa is said to be mulling resignation in a scandal that is threatening to take down, well, far more than just the South African president. We're going to bring you the details on that unfolding story. That is next. This is Bloomberg.
at the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Welcome back to the Open. 51 minutes into the European trading day. Yes, you're seeing losses across the benchmark here in Europe, down 0.3%. Of course, investors looking ahead to the non-farm payrolls print in terms of a guide on the next steps for the Federal Reserve. The estimates are for 200,000 additional jobs, so slightly lower for the month of October. The futures in the US pointing lower by 1/10% for the S&P E-minis, down by 0.2 on the Nasdaq futures. Francie.
Now let's take a look, Tom, at some of the things to watch out for today. At 10 a.m. UK time, we'll have the Euro area PPI reading for October. Then at 12 p.m., we'll have industrial production data from Brazil, followed at 1:30 p.m. by the big one. Plenty of data from the U.S., including the eagerly awaited November jobs reports. Also at 1:30 p.m., Canada releases its November unemployment figures. And then later today, the ECB Vice President, Luis de Guindos, speaks at an event in Madrid.
Also later, Chicago Fed President Charles Evans going to speak at a couple of events in Chicago as well. So another voice before the blackout period and that decision in the second week of December from the Federal Reserve. From the Fed, though, to a really important emerging market story. South Africa and the president there, Cyril Ramaphosa, is said to be mulling resignation in a scandal that is threatening to take down more than just the South African president. Hanging in the balance are the fate of his party and his government's reform agenda as lawmakers consider impeaching him over his alleged failure to properly report a robbery. Joining us now for the details, I'm pleased to bring in Bloomberg's Johannesburg Bureau Chief, Amagalang Mbatha. Good morning. Thank you for joining us. South Africa's president then at risk of facing impeachment, and just a few days ago he was in the UK, of course, meeting the King and the Prime Minister, Rishi Sunak. How did the fortunes of this president change so dramatically, so quickly?
And yes, they've changed quite dramatically, as you've just said. Well, it all really culminated earlier this week when an independent panel, which was appointed by South Africa's parliament, released a report saying that there may be grounds to impeach President Cyril Ramaphosa. This, of course, related to a robbery at his private game farm, wherein around $4 million may have been stolen. It is alleged that the president may have concealed the robbery, and because of this, he may now face possible impeachment.
Amo, I mean, this story is pretty confusing and certainly took some investors by surprise. So will he go voluntarily? Is there a real chance that he resigns? Is there an impeachment process underway? Is there an investigation? Like, what happens next, and what does it mean for the markets?
Well, I mean, there was a lot of drama just yesterday when the president met with his key allies in Cape Town. It was said that he was indeed considering resignation. However, it seems at this moment that they have been able to talk him out of resigning. What is next, though, is that the ANC's top leadership, the National Executive Committee, will be meeting this afternoon to discuss this very matter. And the next phase will be next week, Tuesday, when the meeting today will decide whether or not they will adopt the report in Parliament or whether reject it. If the ANC caucus in Parliament decides to adopt this report that may possibly impeach the president, it could mean that the odds against him. But if they choose to reject its adoption, it will mean that the ANC indeed will be defending its president.
What does it mean for the ANC's future then?
Well, the ANC will be meeting in about a couple of weeks' time to elect a new president. Ramaphosa's key allies have encouraged him to remain in office until the end of his term. However, remember that this is a man who really went about with an anti-corruption campaign. So for him to be tainted in any way, shape, or form really does put a stain on his reputation, so to speak. So it seems as though he has said, he was quoted as saying that he would rather resign himself than be taken out of the presidency by the ANC or through parliament. So everything is still on the cards. The ANC will be looking into this matter, and we'll see how it unfolds over the next couple of days.
Thank you so much. Of course, Johannesburg Bureau Chief Ambo Mbatha there with the very latest on South Africa. Now joining us soon, our exclusive interview with Enoch Godongwana, South Africa's finance minister. That will be an interesting conversation, especially for investors and the markets. That's at 9 a.m. London time.
Yeah, really important, particularly across emerging markets, the fate, of course, of the president of South Africa. Another important story, and of course, the exclusive interview that Francine had with the chairman of Credit Suisse. Let's check in then on the stock, currently gaining 1.3%. Again, that exclusive sit-down, of course, between Francine and the chairman of Credit Suisse, where he kind of said, look, clients, yes, of course, they've been rattled, but he and his sense is they're going to come back, and importantly, saying that outflows have now effectively stopped, Francine.
Yeah, look, I really enjoyed the interview because actually he seemed quite frank. He had a lot of energy. He didn't shy away from answering questions and saying, look, it will get better, but he also realizes that, you know, things are not going great at the moment. I imagine if you're a big shareholder, an investor, at least it's refreshing because he accepts and understands the huge concerns and problems they've had.
And that capital raise, clearly that decision was tortuous for him and the board, and it was ultimately the one that they came to. They're going through that process now. He says there will be more stability once that's completed. The share currently trading at 273, the offering is 252. Markets here broadly across Europe, you're currently seeing losses of 0.4%, futures lower as well in the US by between 10th and 2/10 ahead of non-farm payrolls. This is Bloomberg.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become chief future officers. The cruise industry shut down during COVID. Now, CFO Naftali Holtz has Royal Caribbean full speed ahead.
Our goal is to get back to the balance sheet we had. This business is very resilient.
Watch Chief Future Officer, Wednesday on Bloomberg.
We're in the early stages
of a sustainability revolution that has the magnitude of the industrial revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority. This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Waiting on jobs, Asian equities and U.S. futures edge lower after a key inflation gauge comes in softer than forecast. The next clue on the health of the U.S. economy, of course, today's non-farm payrolls. Crisis in Cape Town while South African President Cyril Ramaphosa weighs resignation amid corruption allegations. The rand takes its worst tumble in 6 years. Plus, bank cuts, lenders start slashing bonuses and jobs. The chair of Credit Suisse exclusively tells us that outflows have stopped from the embattled lender.
The outflows basically have stopped. What we saw is 2-3 weeks in October, boom. And since then, flattening out, they have stopped. It's gradually coming back, in particular in Switzerland.
Well, first thing is first, so let's check on the markets. Now, European stocks are pretty much trading sideways. There's not a huge number of news out there, apart from here and there a couple of pockets of concern. We look at OPEC Plus, of course, over the weekend. The big story is what happens with the Fed, and we have that non-farm payroll a little bit later on. We have a special show to see whether we can infer from that what the Fed does next in terms of aggression or not with interest rate hikes. Technology stocks gaining some 0.4%. The U.S. dollar index 125.4, and then Bitcoin 16,967. One of our reporters actually flew to the Bahamas to interview the FTX founder, so don't miss that interview. We'll bring you that throughout the day. European maps, this is a good indication. First of all, there is also a lot of speculation that it's going to be quite hard for an oil price cap, also a gas price cap from these European countries. You can see the FTSE down 0.4%, similar loss for the CAC 40. The FTSE, maybe in Italy, holding up a bit better than the DAX, actually seeing a couple of gains, 0.1% higher. Now, we do have two exclusive interviews to bring you this hour. In a few minutes, we'll be joined by the South African finance minister as a scandal threatens to take down the country's president, Cyril Ramaphosa. Plus, we'll also have more from my interview with the chairman of Credit Suisse, Axel Lehmann, on the bank's sweeping overhaul.
When I speak to clients, I know, that there will be inflows. We already see it partially happening. So we have plans to continue to reach out to clients. It might take a little bit of time, but it will, it will come back and we'll go back to normal.
Well, we will have more from that exclusive interview with the Credit Suisse chairman a little bit later. Now, there is a risk-off mood in markets as traders look ahead to a U.S. jobs report for clues on the Fed's rate path. Bets on the peak have now dropped below 4.9%. That's according to swap markets. We're now joined by Laura Cooper, senior macro strategist for iShares EMEA at BlackRock. Laura, always great to have you on the program, so thank you so much for coming on. U.S. jobs, non-farm payrolls, the big one. Will they change your expectations of what the Fed does?
I don't think they're going to change expectations for what the Fed does, largely because I think the Fed is going to look through it. If it's a very strong print, they've already alluded to the fact that employment remains robust. If it is a downside surprise, we could actually see markets have a risk-on rally on the back of that, largely because the Fed has already kind of said that they're going to have a pause at some point. So I think for the Fed, though, they're probably going to look through the jobs data. It's quite a high bar for disappointment for them to actually change away from that 50 basis point increase in December.
Laura, what's being mispriced at the moment? So I know, and this I feel like we go through every week, if not every day, is that the market believes that the Fed is slowing down the pace of interest rate hikes. But the Fed is also saying, guys, we're going to have to hike, maybe gradually, but it's going to be painful to get where we need to be to deal with inflation.
And that really is an interesting divergence. And the market reaction that we saw on the back of Fed Chair Powell's speech on Wednesday was quite surprising because the messaging didn't really change. This is going to be a higher for longer environment, although more gradual pace, which is increasingly prudent as we get to that terminal rate. So I think in terms of what's mispriced, probably the terminal rate now, given the paring back of expectations on the back of that speech, we do expect they're going to over-tighten to such an extent that we are going to see a recession next last year, and that's yet to feed through into the employment data. And then to the second point, I think it's really around earnings continue to be mispriced, and it's why we are still underweight developed market equities because they're too optimistic.
Right. So why the optimism? Is it because we were coming back out of 15 years of growth and actually an understanding that everything will be fine, or are there glimmers of hope where the market could be right?
Well, I think at this point, and the way BlackRock's positioning it, is this is a new macro regime that is going to be marked by higher inflation. So that requires a new investment type of playbook, one to actually position quite differently than that great moderation that we've seen over the past several decades. So I think at this point, it does require investors to really rethink their allocations and portfolios.
So where do you find the best value right now? Or where do you invest to make money?
Well, it's really about taking a selective approach. And the way we do this is through two lenses. So one, taking a risk-on, very granular approach to portfolios. So looking where those market pricings are to find those opportunities to dial up risk. So we like European banks, for example. We still like traditional energy, clean energy, but as well taking a bit of a defensive tilt as well. So healthcare, yes, it's a little bit expensive at this point, but we do think it's going to benefit from those near-term tailwinds of demand, but as well as those long-term structural forces around aging demographics.
Laura, thank you so much. Laura Cooper, their senior macro strategist for iShares EMEA at BlackRock. She stays with us now. Coming up, as Cyril Ramaphosa's presidency and government is engulfed in scandal, we also speak exclusively to the South African finance minister. He's Enoch Gondogwana. That's coming up next, and this is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Watch Bloomberg Surveillance Early Edition for the news you need when you need it.
I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Inflation hasn't been this high in the UK since 1981.
Then surveillance for in-depth analysis.
Jonathan Farrell, Lisa Bramwitz, Tom Keene, thrilled you're with us.
Inflation in the United Kingdom, brutal.
Underlying food inflation doesn't appear to be that bad.
It ties back to the tenuous situation of what we're looking at with respect to energy.
Bloomberg Surveillance. Be informed. Be prepared. Be ahead of the game. Today, all eyes are on the jobs report.
Jobs report Friday is going to be huge.
It's the final stretch of 2022.
Is there actually going to be some change in the tone?
Wage data might be more important than the CPI.
Today, Tom, John, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
The labor market is stronger than people have thought it would be.
The recession is not here yet, but the check is certainly in the mail.
We're going into a downturn at full employment.
The November Jobs Report, today on Bloomberg Television and Radio.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the South African rand has tumbled towards its worst decline in 6 years as Cyril Ramaphosa mulls resigning over a growing scandal engulfing his presidency and his government. We're now joined by the South African Finance Minister, Enoch Godongwana. Minister, thank you so much for joining us on Bloomberg TV this morning. What are the kind of conversations that you're having with investors and conversations within your party?
Look, with conversation we've had to investors, the latest conversation has been around the medium-term budget policy statements, where we've been looking at how we view the outlook, how is our fiscal framework, discussing all of those elements, which has been positively received.
But so, Minister, what does this mean? What's the latest thinking on your party, on your president? Does he need to go or can he stay?
Look, we have been watching the developments in Parliament. Parliament set up a committee called Section 89 Committee, whose intention is to establish whether there is a prima facie case for impeachment. The committee has released its findings on Wednesday, and Parliament will examine those findings and take the appropriate decision on Tuesday, the 6th. What we anticipate is that on Tuesday, the 6th, it will only be a process. There will not be a final discussion. That process, if agreed upon, will probably lead to, if an impeachment takes place, and then they will another process will unfold, and if a decision is recommended for impeachment, it's going to require 2/3 majority of Parliament. But from the party perspective, the party's national executive.
No, sorry, go ahead.
The party's national executive, the party is meeting this afternoon at 2.
And what do you think will be decided at 2? So if there are grounds to go ahead with impeachment, will the party encourage the president to step down?
My own summation at the moment is that the party upholds this constitution and therefore would not be want to be seen found wanting on the principles of accountability and democracy. To the extent that is an accountability process, I think the party will probably agree to that process to take its course, and the president will be held accountable and explain to Parliament and whatever it does. I don't think the party will object to that. Whether the party then, when it comes to the final decision, will agree with the final decision, I don't know.
Minister, President Ramaphosa is widely considered market and investor friendly. In the case he were to step down, and given all of the uncertainty about his future, impeachment or otherwise, what message would you give to markets and investors today?
What I would say, interesting enough, with South Africans, we've got a kind of a turbulent kind of a political process where new Democrats were kind of marked by a lot of these disruptions and disturbances. The smooth transition we've had is only one from Mandela to Mbeki. Since 2007, we've never had a smooth transition, and it has never had an impact on the macroeconomic framework and policies which we've continued to pursue. So it's even if you read the newspaper today, it's noisy, it's our nature.
But would you be willing and available to stay on as finance minister if President Ramaphosa steps down?
No, I mean, I serve at the request of the current president. If any new president, if he steps down, a new president asks me to stand, I will have to evaluate that depending on the policies is likely to pursue. But in general, yes, I will stay.
Minister, your budget update last month showed a marked improvement in debt and deficit trajectory. Are you worried that the scandal will reverse that progress?
No, it has got nothing to do with the macro variables at all. It's not likely to impact. We pursue The budget we're going to table in February will be based on the fiscal framework which we have tabled on the 26th of October. So I don't see that impacting on those macro variables.
But Minister, I mean, credit ratings, right, are suddenly saying that there's maybe an inflection point. If you have a change in president with possibly new policies, this would 100% have an impact on macro policies and the debt trajectory and everything that goes with it.
No, well, you know, the difference people compares us to the Americans. The Americans, a president has got a policy. In the South African context, the policy does not belong to the president, it belongs to the party. What you should watch is not who is elected, is what content emerges out of that conference in the form of policies. Any president is not going to pursue individualistic policies outside the policy framework of the party. So, to me, that's not the major worry.
But this could hurt the chances of the ANC going into elections or not?
The ANC is going to go into an election. I'm quite convinced a number of people are beginning to write an obituary for the ANC. As a leader of the ANC, I do not accept that narrative. I think we'll still be a major player in 2024.
Minister, you're pretty optimistic that actually, you know, the political uncertainty may have unnerved investors, but actually doesn't change the trajectory of South Africa. Will it a lot depend on actually what the ANC decides? I know you meet at 2 p.m. When will we have news on what was decided?
Let me just say this type of sensitivity arises. I don't deny that when Mbeki left in September 2008, a similar challenge faced us. When Zuma left in 2018, a similar challenge faced us because they didn't leave the office in a procedural way. So what I'm trying to say to you, we are used to this kind of disruption, and we've always found ways of managing it.
Minister, President Ramaphosa has no obvious successor.
It does not. It does not mean, as I'm saying, it does not mean we've accepted that President Ramaphosa is leaving. I'm just saying in the case of that happening, we will find ways of managing it, but I don't see it happening at the moment.
So what's the likelihood, if you're a numbers man, an economy man, what's the percentage chance of the president leaving? Is it 50-50? Is it higher or lower?
10%.
10% if he leaves. And the successor would be who? Because there's no obvious successor right now.
There's no obvious successor for now. My prayer at the moment is that he remains, he wins the election of the party in 10 days' time, and we proceed, whether there's an impeachment, it's a parallel process, we proceed with that. We go to 2024, win the elections. He's popular more than the party. Both our internal survey and survey by partners is popular with South Africans more than the party.
Minister, thank you for your time today. I hope we make this a regular occurrence as we continue following, of course, some of the travails and opportunities in South Africa. Enoch Gondwana, the South African finance minister, joining us this morning. Now, coming up later in the program, Goldman Sachs also warns its traders that bonuses will be slashed. So we look at the economy. We also go back to the South African story. This is Bloomberg.
digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
Like a weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The European Union is closing in on a deal to cap the price of Russian crude oil at $60 a barrel. It's the bloc's latest attempt to clinch an agreement before a Monday deadline. But we're told Poland continues to push to harden the sanctions package before signing off on the price cap. Talks are continuing. In the US, President Biden says he won't apologize for a new climate and tax law that European leaders say unfairly subsidizes American companies. The row is threatening to overshadow the visit to the US by French President Emmanuel Macron. The EU has said it may take the US to the World Trade Organization over the law known as the Inflation Reduction Act. OPEC has slashed oil output by the most since 2020. That fulfills a new agreement aimed at stabilizing world oil markets. Group leader Saudi Arabia led the cuts, followed by its Gulf neighbors Kuwait and the United Arab Emirates. The 23-nation alliance angered the US when it announced a significant supply cut in October, with the White House accusing Saudi Arabia of endangering global growth. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Thank you so much, Leanne. Now let's get back to Laura Cooper, Senior Macro Strategist for iShares EMEA at BlackRock. We were talking, Laura, and thank you so much for staying with us. We're talking a little bit about some of the opportunities and where the smart money goes. I don't know whether there's a huge difference on whether European countries find a price cap, or whether you look at ECB. Like, what are the main shifts that you'll be looking out for in Europe in the next 6 months?
I think the two things that we're watching for are any changes in risk sentiment that are actually looking to be sustained. That's not our kind of base case at this point. And the second thing is what's in the price. So we think at this point, given the significant rally that we have seen in European equities since those earlier November lows, that's farther away from pricing in the recession risk. We still anticipate multiple quarters of contraction coming through the European economy, which is not accurately reflected across European benchmarks. Now, when it comes to the ECB, I think there is this upside risk of them tightening even further. We did have comments from Christine Lagarde earlier today highlighting that this is an exceptionally uncertain environment. They want to keep inflation expectations anchored. So that's really the key thing we're watching for is guidance from them.
Laura, how risky is it in the next 2 months? I know we've had a relatively mild winter so far. And so I don't know whether we've forgotten how tricky energy prices are for inflation, or whether you think that's already priced in.
example, I think we have yet to see peak in core inflation in terms of Europe, and that's the key focus that we're going to be watching for. Now, as we head into the back end of the year, we do have this technical Santa rally. There's really hard to see a key catalyst to kind of curb this risk rally that we have seen, but certainly looking into Q1, I would expect that those inflationary pressures are going to feed through more materially to margins, and at that point, the economic deterioration will be most acute, and I would expect that that's when risk assets are going to have even more pressure.
Laura, do you get into UK assets? I feel like we beat up on the UK economy every day. There must be an entry point.
I think certainly there has been attractive entry points. Looking at the FTSE 100, for example, it has been a strong outperformer so far this year, but it really kind of the investment base case for us is looking for very selective opportunities. So whether that comes in terms of energy, whether that comes in terms of very key kind of healthcare sectors within that, but more broadly, I think there's still a lot of challenges facing the UK economy that takes us away from staying kind of high exposure within UK assets.
Laura, thank you so much. Laura Cooper there, Senior Macro Strategist at iShares EMEA for BlackRock. Coming up, the chair of Credit Suisse also tells us that outflows have stopped from the embattled lender. More from our exclusive interview with Axel Lehmann. That's coming up next, and this is Bloomberg.
There is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together.
Now I would have a much more experience about those who says I love you and then betrayed you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci's really teetering on the brink at this stage.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Well, here are your top stories. Waiting on jobs, Asian equities and U.S. futures edge lower after a key inflation gauge comes in softer than forecast. The next clue on the health of the U.S. economy, non-farm payrolls. Crisis in Cape Town. South African President Cyril Ramaphosa weighs resignation amid corruption allegations. The rand takes its worst tumble in 6 years. Plus, bank cuts. Lenders start slashing bonuses and jobs. The chair of Credit Suisse tells us that outflows have stopped from the embattled lender. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the chairman of Credit Suisse says the bank has mostly stemmed the huge outflow of clients' assets that have helped send their shares to a record low. Well, Axel Laban spoke to me earlier.
Of course, that's never easy. We have quite a lot of roughly some 10 key investors. They are long-time investors. They are not pleased where the share price is, of course. But, you know, they welcome our plan to transform the company. They have a high belief in the credibility of the management team. So they are standing by. But, you know, they are somewhat impatient. They want to see the change. They want to see us executing. And exactly that's what we are doing.
So what kind of conversations are you having with them? Are you confident, first of all, that the share price after the rights offer will go up?
Look, we are at 0.2 or so price to book. All our peer companies in our sector are roughly hovering around book, slightly below, slightly above. There's no reason that we cannot, catch up and go back to that level. Ultimately, I cannot predict when that is happening, but the upside potential is huge.
How much? So what I'm trying to understand, what a lot of people are trying to understand, is that every day there's bad news on Credit Suisse, and you see staff leaving, you see investors unpleased. Like, how do you recapture that narrative?
Look, we had, beginning of the month, we had that social media storm that had a huge impact on, interestingly, not on the institutional side. Professional investors understood there was a lot of rumor spelling, but on the retail and wealth management side. So we reached out. We reached out to 8,000 wealth management clients. They are covering roughly 80% of the assets under management. We reached out to more than 24,000 clients on our core market. So we intensified the dialogue. Just to make sure they understand where we are and just to make sure we maintain the contact. But
what was the feedback like? So if I'm a new client, if I'm an old client, why would I put $100 million with all of the uncertainty surrounding Credit Suisse?
No, the feedback is quite astonishing. The clients still like us. They continue to do business with us. So we had basically very few clients really leaving. They might have, in light of those rumors, withdraw, some money from us. But I'm confident. I have a lot of personal discussions with clients. I know from regional management, that money, when we do well, will come back, at least to a significant part.
When do you think the outflows will stop?
The outflows basically have stopped. What we saw is 2-3 weeks in October, boom. And since then, flattening out, they have stopped. It's gradually coming back, in particular in Switzerland.
I mean, a number of analysts are also talking about, what could happen to Credit Suisse. So are you evaluating other strategic options, given the share price dilution and the market reaction to your announcement?
Look, when you step back, we do a capital increase now. In 4 working days, we will have $4 billion with a CET1 ratio of 14% or close to 14%. That is top quartile in the industry. So it's a really strong balance sheet to carry through that transformation we go. So we execute our plan.
But why do shareholders not believe you? Why does the share price keep on falling?
No, I think the shareholders, core shareholders, they believe us. And they will exercise also their rights. The share price is falling, yeah, of course. The rights issues are traded. The market tries to drive down the price, which is logic, but it's fully underwritten, will be done. So the volatility on the share price will continue until we are through that capital increase. Then I think it will somewhat, stabilize and probably, we just move on from there. So,
Chairman, no plan B. Is there a plan B? If somebody came today and said, look, I offer you to merge 10 Swiss francs.
Look, as chairman, you need always to consider all. When somebody comes and would do that, of course, you need to take a look. But, I tell you, when you are where we are, with the historically low on the share price, with a great management team, with a plan that is convincing the market, and the market, our shareholders believe it. It takes time to execute. We can capture that value, and we will do so.
How difficult is it to retain staff?
It is obviously a challenge. Now we have so many people, 50,000. I think they are very much under pressure, very committed. We have still excellent people, and the good thing, we continue to attract and hire, I think, very, very strong caliber individuals. But it's something to watch closely, clearly.
But how do you attract them? So again, because the franchise is tainted, do you have to have difficult conversations with people?
It's interesting. Also, when I look to people we attracted at the board or in the executive committee, they see it's a great franchise, a franchise that is a little bit hammered, but they see the opportunity, they see the potential, and they think that is what attracting new talent.
But the worry, I guess, is that if you have Credit Suisse on your CV, does it make you then less applicable afterwards? Are these conversations that you have with people, or it's not a problem?
No. Look, we should not forget Credit Suisse is one of the best brands you can have. It's not only in Switzerland, but you go to Asia, you go to Latin America. I mean, it's a super brand and such a rich history. And in every time in life, we have ups and downs. Yes, we are not in the best shape, but we are getting back, and that is what people see, and that's what they believe.
So when are you expecting inflows to increase? We talked a little bit about the outflows and when you're expecting them to stop. How do you attract new clients?
No, I said I already see now. Anecdotally, when I speak to clients, I know, that there will be inflows. We already see it partially happening. So we have plans to continue to reach out to clients. It might take a little bit of time, but it will come back and we'll go back to normal. I think we just go now through a little bit that storm during the capital increase. When we are done, we are done, and then you start to work step by step. No rush, step by step, executing a plan, and then we are going back on track.
That was Axel Lehmann, the chairman of Credit Suisse, speaking to me a bit earlier. Now, coming up, as the Ramaphosa presidency and government is engulfed in scandal, we talk South Africa politics and economy and also investments with 91 Chief Executive Hendrik du Toit. That's coming up next, and this is Bloomberg.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacroix here in London. Now, South Africa's rand is extending gains after 2 days of turmoil, but traders are bracing for more short-term upheaval from the leadership crisis engulfing the ruling ANC party and President Cyril Ramaphosa. Well, let's get straight to Henrik du Toit. He built the asset management arm of South African banking group Investec from scratch in 1991. He pressed ahead with its listing, renamed 91, on both the London and Joburg stock exchanges during the coronavirus outbreak. And Hendrik joins us now. So thank you so much for joining us. So you understand South African investment and politics more than most. Where are we now in terms of the processes put in place and what this scandal and these alleged, theft means for President Ramaphosa?
Good morning, Francine. I think what's important for outsiders to understand is that South Africa has a very strong constitutional framework. Yeah. For all its flaws, it is a parliamentary democracy, noisy as it is, that works. And what is followed here is a report from a panel that advises, at request of Parliament, is advising Parliament on what they should do under their Section 89 of the Constitution, or the obligations they have under that when there is a question about the behavior of a president. Then there's a ruling party. And I saw you spoke to the finance minister, who's also a senior member of the ruling party. The ruling party has its own processes and is a few days away from a leadership election. So that is the complexity.
Yes, and in that interview with the finance minister, also part of the ruling party, ANC, I mean, he was very clear, first of all, in reminding everyone and reminding investors that South Africa is not like the United States of America. I think he said something to the effect of, we're used to alleged scandals and it's fine for the economy. I mean, is there truth in that? Again, because it's complicated and we don't really know if impeachment comes, if there's ground for impeachment, or the president fights, what does it mean for an investor?
I wouldn't quite agree with your summary. I think what Inogwanagwana meant was that South Africa has a parliamentary democracy and the president is also constrained by the ruling party, and the party has very strong structures, which means the president must abide by both, and therefore whoever is president has to follow the party and play by the constitutional rules. And remember, we got rid of the previous president in a process similar to that. So the country is used to doing that. I think where we are really, where the markets are worried and where people are concerned, is Ramaphosa was a reasonably market-friendly president, has spelled out some clear policies, all of which have not been executed, but at least are understood by markets.
But so, Hendrik, talk to us about if the ANC holds the ultimate power, right, maybe even more than the individual, then the policies wouldn't really change under any president, although there's not an obvious successor.
The whole National Executive Committee will be reconstituted on the 16th of December at a conference, ANC conference. The president of the ANC, and Ramaphosa, was standing for re-election and is standing for re-election, will obviously lead it. So it is very significant for the country as it then goes into a general election here in 2024. So that's really, and so does the country need this? No. Does the country have the wherewithal to process this? Yes. But the next big date is the 6th of December when Parliament is debating this. And so I think having it's not a one-day game would be my answer. And therefore, if you're in markets, you should be thinking about a few months of uncertainty in South Africa.
What happens in those couple of months of uncertainty? I know there's pressure on the rand. There's, what's almost a shame is that there was just a turning point for credit ratings when you look at that debt trajectory.
100%, and actually quite a solid, as the minister spoke to you about this morning, solid fiscal framework, fairly good results, a central bank that is in control of the inflationary situation. So you had all these sort of reasonably good things, and then you get this. Now, the president ought to answer some questions in Parliament, and I think that is the right venue for him to answer questions. We will see. There were rumors yesterday that he may resign. I think the hints are to the contrary, that he is actually going to go into the process saying, look, a report has been written. I dispute some of the issues. And by the way, the report is not damning. It used the word prima facie or phrase and that may even be disputed. But there are questions to be answered, and we're in the middle of this very volatile political moment.
Hendrik, are you cutting exposure to South African assets?
I think the time to have cut exposure was to cover for the uncertainty of an unexpected report by Judge Ngobo. That happened. I think right now we see things fairly valued, and we're looking ahead. We don't think the policy trajectory of the ANC will change significantly, but there is a risk that a particular faction that is associated with the corruption under the Zuma administration may gain too much power. I think that is the moment to watch out. So post 16 December, we will have much more knowledge, and markets will probably be cautious until then.
Hendrik, I mean, this is not a sleepy Friday. We also have the U.S. jobs reports. And we've talked about this in the past, the fact that markets want to believe only the part where the Fed says they're not going to hike as aggressively without really understanding how much they need to hike to fight inflation. What are you expecting from jobs today?
I think on the jobs report, I don't think it's the main short-term number.
Yeah.
To me, and the U.S. economy has been pretty dynamic, so you could have a good news, you could not have them, who knows. I think the point here is you need to argue, will central banks be more conservative than markets estimate or not? Our view is very clear. We think Jerome Powell does not want to be Arthur Burns, and we think that central banks, having been behind the curve, most likely to err on the conservative side, and therefore we're still in for a period of volatility, and these sort of wonderful days like last week, just before the weekend, are days probably not to be believed.
But Hendrik, is volatility a polite way of saying correction? If interest rates go up to a level where they need to go to fight inflation, what does it mean for equities globally?
We think the tussle between the bulls and the bears is not over.
No.
And therefore, this is a market which you have to trade rather than see direction. Once we are clear that interest rates have peaked, there is room for bullishness in risk assets. We are still some way away from there, and that's really the key point. And therefore, if you have these big moves, beware on which side of them you are, and we definitely at 91 are in the middle rather than just immediately believing the good news, because I think it's too early for all the good news. And last week we saw the markets unwind.
So traders are finally earning their money for real.
Traders and traders have a real place in this market.
When does it stabilize? Mid next year, or does it take longer?
I think our view is towards the second half of next year, we'll have much more clarity. Clearly, if you're a long-term investor, you want to position ahead of that. And so data over the next few months will be followed very keenly, and then one has to build scenarios. But we are in for a week here economically, globally next year. And if we look at the news out of China, it is yes, the markets have bounced, but there's still a lot of work to do to get global demand up to where we can have a good economy with a stable interest rate environment.
Yeah, we need another 2 hours to talk about China, so we'll get you back in. Hendrik du Toit, thank you so much for joining us today. That was the chief executive of 91. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Blackstone's $69 billion real estate fund for wealthy individuals says it will limit redemptions. It's one of the most dramatic signs of a pullback at the top profit driver for the firm and a chilling indicator for the property sector overall. The news sent Blackstone shares falling as much as 10%, the biggest drop since March. Now, Wells Fargo has cut hundreds more mortgage employees, the latest in a series of reductions across the industry. That's as higher rates brought the pandemic-era home lending boom to a halt. We're told the reductions are taking place across the U.S. The firm isn't alone. Rival J.P. Morgan cut hundreds of home lending staff back in June. Now, Goldman Sachs traders are in for a nasty surprise this holiday season. a cut to their year-end bonuses. We've been told executives in the firm's global market division were told this week that its compensation pool will be slashed by a low double-digit percentage. That's despite the division being on its way to posting their biggest revenue haul in almost more than a decade. And Jefferies is also warning staffers that the upcoming bonus season will be difficult. That follows a volatile year across Wall Street. Bonus pools are set to drop sharply across the finance industry amid a pullback in M&A activity. Jefferies says the process for compensation will be done fairly and also transparently. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Coming up, a rude awakening. Goldman Sachs warns its traders that bonuses will be slashed. So we'll have plenty more of that story that Leanne was also talking about. We're at the compensation discussion stages. So what happens next? This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. Our Francine Lacqua here in London. Now, Goldman Sachs traders are in for a bit of a rude awakening. Bloomberg has learned that the lender warned executives in the global market division that its compensation pool will be slashed. The bonus reduction by a low double-digit percentage follows a similar warning from Jefferies, which blamed a volatile year across Wall Street. Now, for more, let's get straight to our finance team leader, Tom Metcalf. So, Tom, first of all, good morning. How big of a surprise is this Goldman news?
Yeah, big surprise, I think, particularly because of the area it's in, right? Everyone's expecting the investment bankers to have a bad bonus season, but the traders, those are the folk who've been really supporting these results at the Wall Street banks. So the fact Goldman is coming out and saying, hey, traders, guess what? Your bonus pool is getting cut. It goes to show just how closely they're watching costs. And also, I think, you know, this year's been a great one for traders, but maybe they're looking ahead the next couple of years and worrying, can we really sustain those kind of results?
So is this something that will happen across the industry? And actually, how surprised were you that that we find about this unit?
Yeah, I mean, look, if Goldman are doing it, I think you can expect others to be following suit. They're normally sort of the bellwether for the industry. And, it's not like their traders have done badly. So the fact, even in a good year for their traders, that they're looking at these kind of costs, that is very surprising. And I would therefore expect other firms to follow suit. You had Jefferies this week also kind of messaging to its staff, hey, this is going to be a rough bonus season. And certainly what is clear is that if you're an investment banker dealing with M&A, or ECM, you're going to have a very big drop from last year.
Tom, I know you and I often speak about Credit Suisse, when we catch up and just have a cup of coffee in the pantry. What did you make of the Credit Suisse chairman? I thought he was quite candid and actually, encouraging without sugarcoating anything that they have to do.
Yeah, no, great get on your behalf, right, to get him speaking today. And I thought what he was saying was, as you can see in the share price, just really what the investors are looking out to hear from. Basically, they've managed to stem those outflows, which is, the first thing, the most essential thing they need to do. And it'd be very curious to see how the bank goes forward, into Q4. Will there be any more messaging outside of the earnings cycle, or will it, get to January, February, and, from Credit Suisse's perspective, they'll hopefully be able to stand up and say, not only have we stemmed those outflows, we've actually started to see money coming back in.
So Tom, you give it. So this is basically in the next 3 to 4 months. Well, we'll see if the proof is in the pudding.
Yeah, I mean, next quarter particularly be critical. It's just been quarter after quarter of bad news. So I really think at this point, Buck's got to stop here. They've got to show signs. They've managed to wrestle their bank to the ground almost, and this big sweeping restructuring is at least starting to kind of take shape, and there's starting to be some kind of benefit seen from it, because if the doom and gloom continues, it's very bad news for Credit Suisse.
Tom, thanks so much. Tom Metcalf with a very cool looking Damien Hirst-like, arts in the background. Our finance reporter, Tom Metcalf. This is Bloomberg.
My grandfather got into the mutual fund business because the average investor could not get a diversified stock portfolio, and it was too dangerous to put, your entire savings in just a couple of companies. So the mutual fund was created to give a diversified expert management at a reasonable price. Today, we have a phenomenon where companies are waiting much longer to go public. And so in 2000, the average company went public after 3 years. Now, companies are waiting 9 to 10 years because there's so much money available in the private markets. As a matter of fact, there are half the number of public companies that there were in 2000, and there's 5 times the number of private equity-backed companies. So just from an investable universe, you look at the private markets, and it's significantly bigger. So the question is, that return that used to be captured in the public markets is now captured in the private markets. But the problem, as you know, is you're really tied up for a long time when you invest in a private equity fund. And so trying to figure out a way to solve the same problem my grandfather was trying to solve, which is how do you bring those returns responsibly, the democratization of the private markets to the retail investors. And I describe it as a bit of like running with scissors. Scissors is a great tool if you use it appropriately. And so we're focused on trying to figure out responsibly bringing it in to the average investor.
Today's Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become chief future officers. The cruise industry shut down during COVID. Now, CFO Naftali Holtz has Royal Caribbean full speed ahead.
Our goal is to get back to the balance sheet we had. This business is very resilient.
Watch Chief Future Officer, Wednesday on Bloomberg.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
I think right now the Kool-Aid is the gloom and doom.
That post-pandemic distortion is probably going to last for some time.
There is an extremely elevated chance of recession, and if you had to place your money, I bet that within 12 months the economy is in downturn.
The most predominant factor that's driving everything right now is where global equities are going.
We have more confidence that this rally will continue into December.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It is 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Waiting for today's U.S. unemployment report, job growth is expected to slow down, but the question is whether the Fed will consider it a turning point. A tale of two banks. Credit Suisse says it is mostly stemmed the outflows that sent the stock plunging to a record low. Meanwhile, Goldman Sachs jolts traders with a warning that bonuses will be cut. And the US ramps up its investigation into FTX. It's pressing top users for information on the failed crypto exchange and its key figures. Welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London alongside Matt Miller and Kaylee Lines in New York. Anna Edwards is off today. And Kaylee, you look across the Asian markets, giving up some of the gains after what was a very strong week for Asia.
Yeah, it definitely was a strong week, but you saw risk sentiment maybe being toned down ahead of the jobs report today. Happy Jobs Friday, everyone. It definitely was a down day for equities, but bonds were bid in Asia overnight. The MSCI Asia Pacific Index as a whole, that equity gauge down about 0.5% after a 3-day winning streak. It snapped that rally. And then the bond market, as we saw Treasury yields moving lower yesterday, follow through of that in the Asia Pacific overnight, including in Australia and New Zealand. In Australia, the 10-year yield down 9 basis points to the 339 level. Then in foreign exchange, when we talk about a good week, we have to talk about the Chinese yuan. The onshore yuan having its best week against the US dollar, going all the way back to 2005. We're talking 17 years right now. Dollar yuan trading at 702.27. And then it also was a good week for iron ore. Actually, the 4th consecutive up week for those commodity futures. That's the longest winning streak going back to December of 2021. Iron ore right now trading around $105, Matt, and that is the highest level since mid-August. It all comes back to the optimism about that China reopening story.
All right, very interesting look at what's going on there. In terms of here, not a lot. S&P futures pretty much unchanged. And I think traders are waiting for this data to come out before they make any moves. We're looking for about 188,000 jobs to 200,000 jobs. I can't remember which one is the whisper number. You can type WHISGO on your terminal to see what other Bloomberg clients are betting on. The Bloomberg US dollar index coming down. Treasuries coming down. The yield going up. 352.26 right now. So this is actually a low yield and a low dollar, kind of a tailwind for stocks. Now we have to wait to see what the non-farms payroll number is. Used to be like the granddaddy of economic statistics, the most important release. I would say the CPI now, maybe just for the shock factor, is a little more closely watched. Bitcoin, by the way, still at 17,000. Well, still, it was yesterday eclipsing 17,000. It's amazing to see that after we crashed down to 16 in the wake of the XTX implosion, we've steadily climbed back up. So even though it was a bad month, November was a bad month for Sam Bankman-Fried and a bad month for Bitcoin, a horrible month for a lot of FTX clients, the underlying asset has retained real stability and actually began to climb. Tom, very interesting stuff. What do you see in Europe?
Yeah, that stability around Bitcoin is a real head scratcher, isn't it? Kathy Wood's still sticking to her $1 million a coin call for 2030. Novogratz reducing his call, though, on crypto, at least on Bitcoin. Yeah, across Europe, look, the sentiment, of course, more broadly, since October has been upside. Year to date, you're down about 9% on the benchmark here in Europe, but since October, you have seen gains of around 14%. Today, though, losses generally across the board. Apart from Germany, the DAX is just up 0.2%. Here in the UK, you're down 0.3. There is that holding pattern, as you've been discussing, ahead of the non-farm payrolls. There's the benchmark then, down 0.1%. We are, of course, also focused on what happens around the jobs market in the US and what it says about the Fed's direction of travel. The pound, though, getting a leg up just by 0.1%, and it's been a good week for sterling as well. 122 on the pound. A couple of individual corporates, just to bring to your attention, there's been an upgrade by Goldman Sachs for AB Foods. It's the owner of a retail company called Primark, cheap clothes, currently up 3% on the back of that upgrade by Goldman Sachs. Credit Suisse, of course, that exclusive interview between the chairman and Francine Lacqua. We're playing that out across the hour. And the chairman saying outflows has essentially stopped. He's even starting to see some inflows as well. There's going to be volatility, he said, during that capital raise, but then he expects stability around the price. Again, there, 6% for Credit Suisse. Matt.
All right, we're paying very close attention to the banks today. Investors are awaiting the U.S. jobs report as well to see if it provides any clues on the Fed's next move. Mike McKee, Bloomberg International Economics and Policy Correspondent, joins us now. So, Mike, what do we expect from the number?
Well, it's interesting. This number hasn't moved around a whole lot in terms of expectations, even though we had that weak ADP report earlier and then weak employment numbers in the ISM. 200,000 has been the forecast from the Wall Street economists that we survey for about 2 weeks now, and nothing's really moved them off of that. 3.7% is the unemployment rate that's forecast. That did move. There was a thought that it might go up a little bit, and it's not going to, at least according to the latest consensus. Average hourly earnings are expected to decelerate a little bit, and the participation rate move up just a little bit. You can see there, that's the unemployment rate, and that's going to be an interesting question. So what happens to unemployment? Because it hasn't really been going up, but as you can see there, at this point, the unemployment rate doesn't generally start to move higher until the Fed has stopped raising rates and even started cutting them. So while unemployment may be fairly stable today, over the longer run, it is probably going to rise, and we have that ahead of us.
Well, and the question is, how much does it rise and how much will the Federal Reserve tolerate? As we look at these numbers today, Mike, is there any part of them that could flip the narrative on 50 basis points this month, or is that now set in stone?
I think it's pretty much set in stone. The question is going to be almost immediately, what are they going to do at the late January, early February meeting, because we're always looking ahead. And that may depend, at least according to what Jay Powell said the other day, on average hourly earnings. His view is that inflation now has sort of moved into the service sector category, can't find enough workers, they're paying more to bring workers on, and that's contributing to inflation. So we take a look at the average hourly earnings outlook, and we have a base effect that drove it up earlier, a base effect that's pulling it down now, but the Fed wants to see average hourly earnings in the 3 to 3.5% range to be compatible with a 2% inflation rate. So keep an eye on that and movement towards that direction.
Yeah, those wages still well above pre-pandemic levels, of course. Mike McKee, thank you very much indeed, previewing, looking ahead to that non-farm payroll number. Stay with Bloomberg for full coverage of the US jobs report, plus an interview with Labour Secretary Marty Walsh. That is at 9:45 a.m. New York time. That's 2:45 p.m. here in London. Now, in banking news, the chairman of Credit Suisse says the bank has mostly stemmed the huge outflow of clients' assets that have helped send the shares to a record low.
The outflows basically have stopped. What we saw is 2-3 weeks in October, boom. And since then, flattening out, they have stopped. It's gradually coming back, in particular in Switzerland.
Okay, we are joined by Bloomberg's finance reporter, Tom Metcalf. Tom, what is the latest with Credit Suisse? How important were these comments from the chairman around outflows and indeed the sentiment amongst clients?
Absolutely vital, and I enjoyed his description of the October outflows as woof, very appropriate. But no, the fact that he's saying, hey, these outflows have been stemmed, and actually in Switzerland we're seeing some inflows, is certainly going to be cheered by investors, and you can see that in the share price. You know, it's up a couple of percentage points today. It's up, long weeks of sort of down performance. So this is what shareholders needed to hear, and obviously now the question is, can they continue to do this? Can they really start to show their sort of wrestling these problems to the ground and have a viable reach out of this mess?
So that's what shareholders want to hear. In terms of bank employees, I'm sure at Credit Suisse, but also at Goldman Sachs and at Jefferies, they're starting to worry about bonuses. How hard a compensation season is this going to be for bankers?
Yeah, it's looking pretty unpleasant. I think it's been widely flagged before, investment bankers are going to have a really torrid time, at least compared to last year. You know, you're seeing M&A activity way down, ECM activity basically non-existent. So those folks see very, very big drops in their bonuses. But what was really interesting last night, it had a scoop out of Bloomberg News' crew in New York about how Goldman traders, and these folks have done very well this year, they're also going to see their bonus pool cut. I think the figure was something in the low double digits. So that goes to show, you know, it's not really about performance this year. It's really a cost story. And also, you know, bankers looking ahead, the executives looking ahead at coming years and thinking, we might have a rough ride here, so we better start cutting costs now.
All right, Bloomberg's Tom Metcalf, thank you so much. And we're going to have more from that Credit Suisse chairman interview later on this hour. First, though, we also have to talk about crypto, because delusional. That is how Galaxy Digital CEO Mike Novogratz described the interview with Sam Bankman-Fried at the New York Times Dealbook Conference earlier this week. He joined Bloomberg Television yesterday, and he basically said, collapse of FTX aside, he's still bullish on crypto in the wake of it. He spoke. Take a listen.
This is a setback for crypto, but there's an inevitability that digital assets are going to be part of our future, and we're going to make that bet. We are going to lean into the opportunity set that we see. There are a lot of cheap assets right now. There'll be a lot of distressed assets. We're going to build for where we think the puck will be in 2 years.
Joining us now for more is Bloomberg crypto reporter Anna Herrera. So, Anna, does Mike Novogratz have good reason to still be bullish?
Well, he runs a crypto firm, so we'd hope that he wouldn't say I'm negative. That would be great for his company, his investors. So, I mean, to be fair, like Bitcoin hasn't fallen that much as you would have expected, given sort of the catastrophe that happened at FTX. So there might be an argument there. We're still seeing some banks working on issuing securities on blockchain. So, you know, if you're thinking of a future where digital assets isn't only necessarily the cryptos we see now, there might be something there. But obviously, as I said, you know, you have someone who runs a crypto firm say, we believe in crypto. So, you know.
We have obviously reporting that shows authorities are asking investors and trading firms that had relationships with FTX what was happening there. You can find that on NINSS on the terminal. Why haven't they gone to get Sam Bankman-Fried? You know, everyone is asking, how come he's still in the Bahamas? How come the DOJ hasn't picked him up?
Maybe he has a very busy speaking engagement, so they can't squeeze time in. I don't know. I don't have the answer to that. I guess this shows they are working on cases. We have reported that they are. It's interesting because, again, we've been hearing Sam Bankman-Fried speak a lot. We had a big story as well today in Business Week. But it's still unclear exactly what happened. I think what he's admitted to is that there was a large margin position that Alameda, his trading firm, had on the exchange. What's still unclear was whether they used customer funds or not to cover that big hole.
All right, Bloomberg's Anna Herrera, thank you so much. Now, another story we're watching this morning, Apple's iPhone 14 production may fall 16 million units shy of expectations this year, according to UBS. Analysts slashed their forecast to 76 million units for the second half of 2022, down from 92 million, which would be a 20% drop from 2021. They attributed the lower expectations to both the manufacturing disruption faced by Foxconn and softening demand for lower-end iPhone 14 models. Interestingly, though, despite that bearish analyst outlook, Apple shares are very little changed in pre-market trading this morning. Actually, essentially not changed at all, trading around $148 a share. It is a much larger change to the downside this morning for Zscaler. This is a cloud security company reported after the bell yesterday. Its calculated billings coming up short of the midpoint of analyst expectations. Analysts really just blaming that on macro headwinds. That stock is down about 9%. And Marvell also down. This is a chip maker for data center chips. its forecast disappointing. And what that really signals, Matt, is that the slowdown in chips is spreading beyond just PCs and smartphones. It's hitting data center as well. And as a result, Marvel is down about 7% before the bell.
Yeah, that's interesting. Now the hardware being drawn into the software concerns, because we'd already gotten warnings from companies like CrowdStrike and Snowflake. So we'll be watching this space very closely. Coming up on this Jobs Friday, Hugh Gimber, Global Market Strategist at JP Morgan Asset Management, and Sandra Horsfield, economist at Investec, talks to us about what to expect from this big number we're awaiting at 8:30. This is Bloomberg.
Stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech and sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become chief future officers. The cruise industry shut down during COVID. Now, CFO Naftali Holtz has Royal Caribbean full speed ahead.
Our goal is to get back to the balance sheet we had. This business is very resilient.
Watch Chief Future Officer, Wednesday on Bloomberg. Today, all eyes are on the jobs report.
Jobs report Friday is going to be huge.
It's the final stretch of 2022.
Is there actually going to be some change in the tone?
Wage data might be more important than the CPI.
Today, Tom, John, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
The labor market is stronger than people have thought it would be.
The recession is not here yet, but the check is certainly in the mail.
We're going into a downturn at full employment.
The November Jobs Report, today on Bloomberg Television and Radio.
Welcome back to Bloomberg Surveillance, the early edition. I'm Matt Miller with Kaylee Lyons here in New York. Anna Edwards normally with us out of London, but we have T-Mac today filling in because Anna is out. We're all waiting for this non-farms payrolls report, and it's going to be interesting because, as Michael McKee was telling us, Wall Street has consistently underestimated the amount of jobs that we get, at least for the last 7 months in a row. That's a record, 7 months in a row of NFP data that was higher than the street was looking for. Joining us now is Lynn Thomason, Bloomberg Markets editor. Lynn, what are we expecting for today?
Yeah, absolutely. Well, I think clearly everyone's watching what will come out of this jobs report. Clearly, the interest in markets is this going to be the turn of inflation? Will we see a softer jobs report? And will that give the Fed the confidence that it can start going slower on rates?
And Lynn, it's been a great month in terms of how you tie that into what's happening across the equity markets. It's been a great month for global equities, whether you look at Europe or the US or indeed Asia. Does this the fringes of a Santa rally, or are things going to fade? Is that NFP number going to give more juice to this market?
Yeah, absolutely. And I think, the interesting thing is everyone's talking about the Santa rally, but in some sense, we've already had a Santa. I mean, there's been such a big rally already. So I think there's a good question of, are we reaching the peak of that, or, will the jobs number give us the fuel to keep that going?
Well, Lynn, it's also a question of when it ultimately will end, even if it keeps going in the near term, because the consensus building seems to be that, okay, we can see the Santa Claus rally. The rally can go on through the month of December, but first quarter of 2023 going to be a very different story. And actually, the consensus outlook developing around next year just in general is that stocks are going to end the year a little lower than they are right now, which is the first time it's happened in what, Miller? Matt Miller?
Like 23 years.
23
Since 1999, we haven't had the average strategist on the street estimate lower for next year than it is this year.
Yeah, Lynn, what do you make of that?
Unbelievable. I think, it really speaks to the level of worry in this market. I mean, strategists are typically such a bullish group. I agree. I can't remember a time where strategists were predicting a down year. So, it speaks to the fact that even though we've seen a bump up in stocks, there's clearly a lot of nervousness and worry about what the next year will bring.
Lynn, the other big story this week, of course, was what was happening in China. And there's the growing expectation you're going to get some kind of reopening next year. I'm still struggling to understand whether this is deflationary because supply chains ease up, or inflationary because suddenly China is back and sucking in commodities again. How are markets thinking about China in 2023?
Yeah, I mean, that's a perfect example of the story. Are they opening up or are they clamping down? And you can kind of see that confusion in how Chinese officials have reacted this week. In some sense, it's going to be harder, and then the next stage, well, we're actually opening up sooner than everyone thinks. Your guess is as good as mine on how it'll play out, but I think, if you look at Chinese equities overall, they're down a lot this year. People have taken some severe losses, and people are probably wondering, when can I get in and ride the growth story when it does open up?
How to time that growth story around China. Lynn Thompson, thank you very much indeed, walking through some of the key market themes. Kaylee.
Yeah, Tom, as we discussed China, a headline actually just crossing out of Beijing that buses and subways can't reject people with no COVID results. So again, at the margin, we're just seeing the incremental relaxation of some of those restrictions. And of course, the market and our market team at MLive, the MLive blog, continue to follow the China story and all the other noteworthy market stories to watch. For more of that analysis, you can check out MLive Go on your terminal. This is Bloomberg.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
We're in the early stages of a sustainability revolution that has the magnitude of the industrial revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Tom McKenzie in London. Now keeping you up to date with news from around the world, here's the first word. In South Africa, leaders of the country's ruling party are meeting today while the fate of President Cyril Ramaphosa is up in the air. He's said to have considered resigning after an advisory panel found that he may have violated the Constitution. The panel investigated his alleged failure to properly report a robbery at his game farm. President Biden will sign legislation that will avert a potentially crippling rail strike. The Senate overwhelmingly approved the measure, which would impose a labor agreement hammered out by rail companies, union leaders, and the Biden administration. But workers in 4 of 12 unions rejected that deal. Meanwhile, Musk's Tesla has handed over its first electric semi-trucks. The event came more than 5 years after it unveiled the vehicle. PepsiCo received the first truck. The move to electrify trucking could be transformative for an industry known for high emissions and hefty fuel costs. And Twitter has suspended rapper Kanye West, who now goes by Ye, after he posted an offensive image. He tweeted an image combining the Star of David with a swastika. Later, Twitter owner Elon Musk tweeted that Ye had violated, again, the rule against incitement to violence. Whoa. And this is what the tension is, Matt, is that Elon Musk says the reason why he took over Twitter, why he wanted to buy it, is he wants to protect free speech, but there's free speech and then there's hate speech. And for a platform that is reliant on advertising dollars, this is why advertisers may now be hesitant about advertising on Twitter, because you don't necessarily know what kind of content your ad will run next to.
I mean, you don't want your ad to pop up right next to a swastika, right? Posted by a guy who, in an interview just previously, had said he loves Hitler and the Nazis. It's just unbelievable and also depressing and offensive. So maybe it's better that he's just not allowed to speak publicly. Tom?
Yeah, I don't think it's controversial to say that he shouldn't be given a platform. And on the advertising, we spoke to Sir Morton Sorrell, the advertising guru here in the UK. He said, look, advertisers are not going to want to go close to this until they get clarity on these issues. Coming up, we're going to be talking markets with Hugh Gimber of JP Morgan Asset Management. This is Bloomberg.
We've invested more than $10 million in our employees over the
past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. And even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that, this is something that, many business leaders are focused on, and, time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at a 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and will continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
This is Bloomberg Surveillance Early Edition, and here's what you need to know. Waiting for today's US unemployment report, job growth is expected to slow down, but the question is whether the Fed will consider it a turning point. A tale of two banks, Credit Suisse says it's mostly stemmed the outflows that sent the stock plunging to a record low. Meanwhile, Goldman Sachs jolts traders with a warning that bonuses will be cut. And the US ramps up its investigation into FTX. It is pressing top users for information on the failed crypto exchange and its key figures. I'm Tom McKenzie in London with Matt Miller and Kaylee Lyons in New York. Anna Edwards is off today. And Matt, of course, the focus is centrally on the NFP.
Yeah, we're watching the jobs number today to get some direction in this market, right? Yesterday we closed almost completely unchanged in the cash trade. Today, we're looking at futures that are also almost completely unchanged. Although it should be noted that after the massive rally we saw on Wednesday, we're back up above 4,000 on the S&P. The dollar index coming off a little bit, not by much, but we're at a relatively low level, 1254 on the Bloomberg dollar index, and we hit a high of 1353 a little over a month ago. We hit a high of 424, I think, on treasuries at that time. Right now, we're back down to 351, so 352 if you round up. Those things should be a tailwind for the equity market. And then I guess if we get, the idea is if we get a lower jobs number, then the Fed can continue to really do its step down because it won't have to worry about a wage price spiral. So I guess today, bad news is good news for equities. Bitcoin right now trading at $16,960, so almost back to that $17,000 mark. We did see it eclipse $17,000 for a little bit yesterday and overnight yesterday. So the stability this month, I think, has amazed everybody in the underlying asset after the centralized exchange. FTX was just the latest and the biggest now blow up that we've seen in crypto. Kaylee, what do you see in pre-market movers?
Well, we have a lot of earnings-related movers, and a lot of them moving to the downside on forecasts that missed expectations, including Asana, the software company. Its forecast came in light, and analysts are saying that this is a company that is even more vulnerable to the slowdown in the technology industry and the layoffs that we are seeing because it is so heavily dependent on the tech sector as customers. So that stock is down about 19%. You also have Marvell Technology, a maker of data center chips, down on a week forecast by about 7%, while Zscaler, which is a cloud security company, also missed on the guidance. It's down about 8%. The one more positive guidance story is a different software company, UiPath. It not only topped expectations in the third quarter, but the fourth quarter view came in above what analysts had expected. So that stock is higher by about 10% before the bell, Tom.
Okay, checking on what's happening across the European equity space then. Pairing some of the heavier losses, currently DAS down 0.1%. Yes, still a bit of a holding pattern for European investors. The context is you've seen about 14% upside for European stocks since October. Year to date, you're still off by about 9%, but it has been a decent rally in the last few weeks. The pound is in focus for us. Take your time back to that mini budget, the chaos of the mini budget of the former Prime Minister Liz Truss. Well, we're a long way from that when it comes to strength for the pound. 122, gaining 0.2%. Just how sustainable is this, though, as you look at the fragility of this economy? And a couple of corporate stories to flag. AB Foods, this is an upgrade for this company. Goldman Sachs seeing a 20% premium for the stock, currently up 3%. Down year to date, but we'll see, of course, if those gains follow through. Credit Suisse, really important story here. Francine Lacqua, of course, of Bloomberg, sat down for that exclusive chat with the chairman. They say they see outflows. They've essentially stopped. Inflows are starting. Of course, they're going through this capital raise. Currently, on the back of that, up almost 6%. Matt.
Yeah, you've got to halt those outflows if you want to continue to be a leader in that business. A troubled bank that we're going to focus on a little bit later in the program. And really, banks are a huge story today, right? Because Goldman Sachs is likely to cut. We've reported bonuses even for traders who've made more money this year than last year. And Jefferies also sent out a note to employees saying it's going to be a tough bonus season. We'll continue to focus on that. Right now, I want to get back to the markets ahead of this big jobs number. Hugh Gimber joins us, global market strategist at JP Morgan Asset Management. And Hugh, I'm sure you heard my assessment that today bad news is good news for equities. Do you think that's true? And what kind of number do you think we're going to get?
I think that is true. What we're looking at in the US labor market now is a point where the only real way to bring this back into balance is to reduce demand. I thought Powell's speech actually on Wednesday gave a very good template for how to read the data today. And I thought he was very clear in saying, look, we have very limited expectation now that participation is going to improve next year. I think there's only so much that the Fed can hope for in terms of an improvement in supply. And therefore, if you want to see wage growth slowing and you want to see that number coming down to a level which is more consistent with the Fed's inflation target, what the market and the Fed want to see today is a softer print and one that points to continued moderation in 2023.
Hugh, nonetheless, I saw a story that really moved me this morning. The average strategist on Wall Street that we tally expects stocks to be lower next year, expects a drop in the S&P 500 for the first time since 1999. Typically, these strategists' forecasts are bullish, and now for the first time in basically 23 years, they're bearish. What do you think about the markets?
Yeah, I mean, first of all, if you look at the macro picture, I think there the consensus is absolutely clear, which is that we know we're headed into recession. Based on our view, that recession is likely to be relatively mild. And I think when you tally that with the moves that we've seen with earnings downgrades coming through over the past few months, we actually think lots of that kind of mild downturn now is already being reflected in prices. So I think you can see positive returns from the US stock market over the course of the next 12 months. It's still going to be bumpy. I think importantly, we still need to get more clarity on where the Fed is going to stop. But we know the economy is weakening. This is old news now, right? And so as we move through 2023, I think you could well see markets looking forward into the recovery that's to come in 2024. And therefore, we think that the outlook is relatively positive for stocks from here.
And it comes back to that question about good news being bad news being good news, I should say, as Matt was flagging. So where does that moderate optimism around equities into 2023 take you? How defensive do you still want to be in that recessionary environment, even if you think that recession is going to be relatively benign?
Yeah, so it's all about where you look within equities, right? So I think there are a couple of ways to do this with a slightly more defensive bias today. I still think that a value tilt is the right way to go, really because of the earnings picture. I think it's less about multiples from here. It's where you're going to see greater earnings resilience. This is a buzzword that we're going to keep coming back to over the next few months. And it's the value sectors that I think have seen a more realistic earnings picture being painted. Coming off the back of Q3 earnings season, there was obviously a lot of disappointment in some of the big tech names. I think that could continue as we move into next year. The other one really is the dividend payers. It chimes with that value over growth setup where you look at payout ratios today, very, very reasonable, with management still really in catch-up mode, having been forced to pause dividends back in 2020. So I think still a reasonably cautious approach in equities, thinking about ways to keep exposure, but with a slightly more defensive tilt, and then waiting to get more clarity on the size of that downturn and the Fed pause before turning a bit more bullish next year.
And we've seen this run up, of course, in bonds, the bond bull market. And you think that has legs. You say in your notes to us, you're more excited about bonds than you have been in over a decade. I just wonder, there's a lot of misunderstanding about the impacts of QT. To what extent is quantitative tightening a challenge to your optimism around bonds?
I actually think the Bank of England has given us the template for QT, which was that when we saw them step into the market back in September, I think the balance sheet and interest rates are going to be used in quite different ways next year. The balance sheet is more about financial stability. Interest rates are the primary tool for tightening financial conditions and trying to slow this economy down. So it's very difficult to look back in history and say this is how QT works for the market, because we don't really have any good examples of that. But I do think we can say with some confidence that if you start to see QT putting pressure on bonds and you start to see liquidity drying up, I think the central banks will actually be quite quick to pull back from those programs. They need something much bigger to break in the economy to push them away from rate hikes than they need to see in markets to get away from QT.
Okay, so you're jazzed about bonds. You see opportunities in the equity market in terms of value. Does that mean that there's no more justifying hiding out in cash?
No, I think now is a good time to be putting money to work, quite frankly, as we look ahead, whether you're looking next year or whether you're looking further out. The valuation adjustment that we've seen this year has been absolutely enormous. I think no one is going to perfectly time the bottom. No one is going to perfectly pick the top in yields from here. But I think you look across bonds and stocks, as you say, and we see plenty of opportunities for investors to be moving off the sidelines and getting cash to work as we push into 2023.
Have we also seen then the death of the dollar's dominance, at least for the time being?
For the dollar, I'd actually be looking outside of the US to path that course next year, because I think it's very difficult to see how the Fed can really weaken the dollar. If the Fed does pause earlier and you end up with a stronger US economy next year, you get back to this idea of growth exceptionalism. If the Fed is forced to keep hiking, you push the US into recession. Global recession then looks very likely indeed, and therefore you get that safe haven flow. So I think to take some of the shine off the dollar, you actually need to see a stronger European picture, a stronger Japanese picture, perhaps with the BOJ coming into play in the spring. Those are the kind of factors I think that you'd need to see the dollar weakening next year.
Yeah, the yen has had quite the run-up, hasn't it, Hugh? Fantastic. Thanks for your analysis, as ever. Hugh Begimba of JP Morgan Asset Management, leaving us with a little bit of optimism. Get that money, get that cash to work as you look to 2023 is the call there from JP Morgan. Right, coming up, Sandra Horsfield, economist at Investec. We'll get more analysis ahead of the non-farm payrolls, the stickiness and the strength within this jobs market. Stay with us. This is Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Tom McKenzie in London. Anna Edwards is off today. And today is Jobs Friday. All eyes will be on the payrolls report out at 8:30 a.m. Eastern Time. The labor market is starting to cool off, but the data may fall short of the turning point that Fed officials are seeking in their battle to beat back inflation. The median estimate says the economy created 200,000 jobs in the month of November. Joining us now for more is Sandra Horsfield, economist at Investec. Sandra, thank you so much for being here. How much softness do you think is going to come through in this labor data?
Probably not quite enough is the answer. Yes, we're looking at a cooling in the labor market. Our own forecast is going for a 215,000 expansion. It's obviously slower than the sort of pace of jobs growth we had post the immediate COVID recovery, but it's still not enough. It's still not at the sort of level where we're getting jobs growth in line with population trends. So not quite enough of a cooling, but heading in the right direction at least.
And what do you expect in terms of wages? Because we heard Chairman Powell talking about that specifically when he spoke this week.
I think until we see a bit more of a slowing in the jobs creation and also in particular in firms' appetite to hire, so vacancies, it's hard to see wages really coming down. Remember, we're still dealing with an inflationary environment where consumers haven't been compensated fully for the sort of price rises, nor do we think that will happen. But for now, it's hard to see them backing down on jobs demand whilst labor demand still stays so strong. It will take some time. Hopefully we'll get there.
Is it possible, you think, to have a recession in which we don't see unemployment climb to 5% or more?
I think that's a sort of Goldilocks scenario. Can we cool the labor market just enough to bring wage demand down without going too high on unemployment? It will be a difficult balancing act. It's certainly one that I think policymakers would like to achieve, are trying to achieve. In this current environment, we're starting from a very low unemployment rate. Perhaps if we get more jobs, more people seeking to enter the job market, so more labor force participation coming back, that will help to address this in a nicer fashion than through a whole lot of job losses.
Sandra, do you expect that when we do see the real evidence of a recession, if, I should say, although Bloomberg Economics has a model that forecasts a 100% chance of recession next year in the U.S., that the Fed is going to turn around and cut rates in 2023. I've heard more and more people say they expect, the middle to second half of 2023 to include maybe 50 basis points of cuts.
We're in that camp too. We do think that central banks do need to be forward-looking. Monetary policy does act with lags. How long these lags are, always hard to tell. But we have had so much tightening already that it will be very hard to avoid a recession just simply through the weight of the interest rate hikes that we're already getting. So if we think by the second half of next year, we could be looking at recession, then policymakers won't need to be as restrictive in their policy stance as they are now. So it's not so much becoming stimulative, it's less restrictive that they're trying to aim for.
So Sandra, as we face up to that recession, and your cause, okay, it's been a relatively mild recession in the US. What is the corporate resilience? Balance sheets are apparently, we're hearing, pretty strong. They've been pretty reserved in terms of capex spending. How does that position the corporates within that environment?
I think corporates everywhere are facing a situation where, for the time being, demand is still being supported by a number of factors. One is households actually still have some of this pent-up savings that they've built up during the COVID pandemic. So in the hits that we've seen, in the inflation hits, there's still a cushion of demand that wouldn't have been there another time. So that's a helpful factor. Of course, letting go of people at this point is also looking less attractive if it's harder to hire them back in the first place. So with that, there's perhaps more confidence by consumers, by corporates. So the picture isn't quite as gloomy as it might be otherwise. And of course, we have to remember the US is actually a beneficiary from higher gas prices, very much unlike Europe that is paying the bill. They're a net gas exporter. Europe is a net gas importer. It's a different distinction.
So when you think about some of those dynamics, how does China play into that? Is China next year, if it reopens, is it an inflator or a deflator? I'm still not clear on this. What is the biggest impact? Is it an easing of the supply chains, or is it demand and inflation becomes actually more sticky because of China?
It's an excellent question. China, we do think, will head towards reopening gradually. One of the side effects of China's zero COVID policies has been that it has been actually easier for Europe to secure some of the LNG that they couldn't have had otherwise because it's tied up in long-term contracts to places such as China. If they reopen and use some of that gas themselves, that will make it more difficult for Europe in particular. The US, on the other hand, will probably see more of the sort of general rebalancing of demand. And so for US producers in particular, reopening and unclogging of supply chains will be helpful. We've already seen goods price inflation starting to come down. And as that continues, that is a positive signal.
So essentially what you're saying, Sandra, is that it won't really hurt the US much on the inflation side of the story, but it could hurt Europe through the energy mechanism.
That's right. I think that the energy mechanism does remain front and center in Europe. There's no quick and easy solution. There's no quick way out of this. And I think that's going to play into the picture. So in Europe, we do see a double-dip recession, not just this winter, but also next winter in the Eurozone. The UK, probably a recession throughout next year because of the energy, in fact. In the US, it's mainly the impact of interest rate rises that we think will be a drag. But that's, as I said, more a question of calibrating the right amount of restrictiveness than trying to over-tighten.
It seems like more of an art even than a science. Sandra, thanks so much for joining us. Sandra Horsfield there of Investec, talking about the difficult job that the Federal Reserve and central banks around the world have. Stay with Bloomberg for full coverage of the U.S. jobs report. Plus, we get John Farrow's interview with Labor Secretary Marty Walsh. That's at 9:45 a.m. New York time, 2:45 p.m. in London. This is Bloomberg.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Countdown to the Close. Welcome to Bloomberg Crypto.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lyons here in New York. Tom McKenzie with us out of London. Anna Edwards is off today. The chairman of Credit Suisse says the bank has mostly stemmed the huge outflow of client assets that have helped send the shares to a record low. Axel Lehmann spoke exclusively with Bloomberg's Francine Lacqua.
Of course, that's never easy. We have quite a lot of roughly some 10 key investors. They are long-time investors. They are not pleased where the share price is, of course. But, you know, they welcome our plan to transform the company. They have a high belief in the credibility of the management team. So they are standing by. But, you know, they are somewhat impatient. They want to see the change. They want to see us executing. And exactly that's what we are doing.
But what was the feedback like? So if I'm a new client, if I'm an old client, why would I put $100 million with all of the uncertainty surrounding Credit Suisse?
No, the feedback is quite astonishing. The clients still like us. They continue to do business with us. So we had basically very few clients really leaving. They might have, you know, in light of those rumors, withdraw, you know, some money from us. But I'm confident. I have a lot of personal discussions with clients. I know from regional management, you know, that money, you know, when we do well, will come back, at least to a significant part.
When do you think the outflows will stop?
The outflows basically have stopped. What we saw is 2-3 weeks in October, boom. And since then, flattening out, they have stopped. It's gradually coming back, in particular in Switzerland.
That was the chairman of Credit Suisse speaking exclusively to Bloomberg's Francine Lacqua. So, Matt, you have to stop the outflows. That is the first thing. Then you have to get the inflows back, a second thing. But there's a lot more work we know that Credit Suisse has to do, including cost cutting and reducing its labor force. And we had the Bloomberg reporting yesterday that they're cutting at least a third of their debt sales positions globally. But that's just one part of what ultimately will be thousands of layoffs across the bank.
Yeah, I think it's going to be a tough slog, and considering the fact that wealth management is the biggest Swiss banking business, it's got to be top priority for them, right? It'll be interesting to see what happens with Credit Suisse in terms of the government, whether they come in and help, whether they look for other solutions. There are always sort of parade plots, rumors about tie-ups with UBS, but this is a story that since Archegos and Greensill just continues to disappoint investors. As a result, those shares are so low. Tom, you know, the other thing that's really caught my eye in terms of banking stories today is as we come into bonus season, it looks very depressing. Even traders at Goldman Sachs, who've made more money for the bank than they did last year, in fact, one of the best years that they've had in over a decade, are looking at a possible cut in the low double-digit percentage terms of their bonuses. And Jefferies CEO Dick Handler also sent a letter to employees saying it's going to be a difficult year for compensation.
Yeah, it was a smashing year for traders at Goldman Sachs. And you've got to wonder if executives are taking a gamble, essentially. They think that maybe because of the slowdown, they can push through some of these reduced bonuses because bankers are not going to be looking elsewhere as actively. We'll see if that plays out. Matt.
All right, that's it for Early Edition. Tom, thank you so much for joining us. Bloomberg Surveillance is up next. Lisa, John, and Tom will join Randy Krosner, former Fed governor.
successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as started out a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
There is an extremely elevated chance of recession.
The Fed's got to pray that the labor market quiets down.
They're going to go gradually. They're going to watch what's happening in response to what they've already done so far.
The catalyst for the next bull market is when the Fed actually starts cutting interest rates.
We have more confidence that this rally will continue into December.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on this Payrolls Friday on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. TK up on a week in the equity market, yields down on the week as well. Going into this payrolls report, the number we're looking for, 200K.
Huge news flow today, and yes, we're focused on jobs, but what we're really focused on is the whisper number.
What's the whisper number?
It's lower.
Are we going to keep this for the rest of the hour? This is weird.
There's some gloom out there. Well, we're bonding. We're getting over our anniversary. Seriously, folks, there's some gloom out there today on the jobs number. It's in the so-called whisper number. I'm going to model 200's the run rate, and the whisper number is a 150-ish kind of thing.
This is the runway into year end. Yeah. We've got payrolls today. Then in a couple of weeks' time, we've got CPI on December 13th. Then December 14th, we've got a Fed decision. Chris Harvey of Wells Fargo said to me yesterday, Lisa, that he thinks Chairman Powell this week took the teeth out of the CPI report in 2 weeks. I wonder how important people think the payrolls report is a little bit later this morning.
Every data point is going to matter. I just wonder how we know if inflation is coming off quickly enough. We think that we've hit peak inflation. We expect numbers to be weaker. How weak is okay? How weak is enough for the Fed to really take their foot off the pedal in some kind of way that is more meaningful?
Is good news bad news today?
Yes.
Oh, don't get
You're going to go with that?
I'm going to go with that.
Okay.
Well, I mean, no. If is good news bad news? Yes. If you get a hotter than expected labor market report, I think that will be read very badly.
The good news is the bush is being delivered today.
2 p.m.
They promised 2 p.m. They promised there'd be a squirrel inside.
Do you want to know what happened last night? He FaceTimed me last night, asked to see my tree, and then he proceeded to criticize my tree.
Wait, what?
For about an hour. I came in this morning. I came in this morning, and he's still going. He's still going about my tree.
Do you have tree insecurity?
He doesn't like how it's decorated. He doesn't like the white lights.
So clearly, clearly that the therapy didn't work.
What's the Martha Stewart thing?
Let's talk about tree envy.
Your tree is perfect, John.
What's wrong with that?
Exactly.
Nothing. It's just John's statement. It's a perfect tree.
Mine is like
the process that we go through to decorate the tree.
Sure, it's like
Tell us about the process.
Discipline.
It's like
military drill.
It's like
Everything's of just sort of equal distribution. Different coloured baubles.
We have like marching music.
We have a theme.
Exactly.
The theme this year is
Tchaikovsky.
Yeah, exactly.
Pearl baubles, white baubles, and glass baubles mixed with, it's good. I'll share it out on Twitter nearer near to Christmas.
You need two dogs so one can
compete up against the trade.
And a squirrel.
That's where
Just
we are. And the squirrel came out after the third day last year.
Equity markets unchanged this morning. Let's rip through the price action going into payrolls. Equity futures on the S&P 500 down. Not even 0.1%, Tom. Yields on the week, TK, I've got to tell you, on a 2-year. This week, we're down 27 basis points on a 2-year yield in America.
Disinversion, but the single number yesterday, John, was to see the VIX close under 20 to me is a huge deal. And to me, it was the market front-running this jobs report. And it's like Dow 10,000. It's not a big deal that the VIX is 19.80 or it's right now 20.18. But just the symbolism of going from 31 and all that gloom of weeks ago down through 20, to me, was a big deal.
See that in the FX market too, Tom. Bit more dollar weakness as well. Lisa, euro dollar, 105 handle.
How much bad news do we need to really be optimistic that the Fed won't necessarily have to move as quickly as they previously expected? At 8:30 a.m., when we get that labor market report, yes, people are having a whisper number that is softer than expected, but how much do wages come down? And we have seen wages roll over just a touch bit decline, 4.7% gain year over year on the last monthly reading. How much do we see that continue? And what pace is enough to give people confidence that the Fed can really perhaps not raise as long or as far? 9:45 a.m. Jonathan Farrell will be speaking with Labor Secretary Marty Walsh. Very curious to hear, first of all, what he has to say about the rail strikes. He was involved in talks with that yesterday, but also just this dynamic between the power of the employee versus the power of the employer. And as a longtime union person, how he would like to see that proceed. And today we do get a host of Fed speak, including Richmond Fed President Thomas Barkin and Chicago Fed President Charlie Evans, one of his last events before retiring. And we now know that Austin Goolsbee of the University of Chicago will be taking over, John.
Lisa, thank you. What'd you make of that, Tom? Goolsbee
Big
in the seat.
deal. I know Professor Goolsbee very, very well. He's a former member of the Milton Academy debate team, among other things. And this is, I put out on Twitter, this is an inspired and controversial choice. Goolsbee comes across so kind and so convivial, I would say, that you don't understand that he's got first-order monetary chops underneath it. That he's underestimated. He's been underestimated his whole career. I thought it was an inspired choice.
Congratulations to him. I'm sure we'll catch up with him.
Krosner, we'll talk to about Goolsbee.
Looking forward to that.
Yeah.
Greg Bowdle joins us now, head of US equity and derivative strategy at BNP Paribas. Greg, Lita and I were talking about whether good news is bad news today. What are your thoughts on that?
I think in the very short term, it could be. The story for 2022 has very much been one of the Fed and rates driving equity markets, and that's indeed what we could have into the year end. You've highlighted the data points, it's payrolls, it's CPI, it's the Fed into year end. But we're looking ahead to 2023, and we think the focus is going to shift away from rates driving equity markets, and it's going to be far more about the real economy and the deceleration and growth next year.
With the earnings story, what is your confidence of your earnings calculation for equity markets into next year? In the last 24 hours, I've seen all sorts of people say, sort of, kind of like we think. Do you have a confidence in that statistic?
No, I don't, and I don't think anybody else should too. And that's kind of really the problem that we face next year. So the bottom-up consensus is still for mid-single-digit growth next year, and we think it's far too optimistic. When we look at our kind of macro expectations of where top-line revenue could come in, we think that's a kind of source of risk. But really where the rubber hits the road in terms of risk is margins. And it's incredibly difficult to model, and we don't think anyone should have any large confidence in where they see U.S. margins come in. But we think the risks to the downside and the risks are material.
Greg, everyone seems to say this on Wall Street, so who's buying right now?
Well, we've seen a lot of money put to work over the last 2 months, and it's been from a kind of collection of sources. So we've seen more than 80 billion of futures bought over the last couple of months. We think at least half of that is hedge funds covering. We've seen systematic strategies such as CTAs put around $25 billion to work over just the last month. And we've also seen signs of discretionary money being put back to work. We've seen ETF inflows of more than 60 billion over the last couple of months. So collectively, that's kind of getting on for 175 billion that we think has been injected into the equity market over the last 2 months. And I think a lot of that is kind of squaring of positions into year end. It's a reduction in this kind of bearishness that we've seen this year, less than it is kind of expectations for a more persistent or elongated bull market.
So what's the trigger going to be for this capitulation that you expect that usually marks the end of a bear market?
So, yeah, I think the analysis we've done is when we've looked back at all of the crashes, bear markets, recessions over the last 100 years, we have seen that there has been this common thread that they do tend to end with capitulation. So capitulation is a move associated with a sense of panic, a rebasing of expectations, analysts aggressively cutting forecasts and volatility spiking. We haven't really seen that yet. It's been an environment where we've had more of a grind lower in equities than an explosive move. Tom was talking about the VIX back at the 20 level. It's kind of indicative of a much more benign environment. Analysts haven't slashed those earnings forecasts next year.
Exactly.
We're looking to kind of Q4 earnings season that kind of kicks off in the middle of January. That is a potential catalyst to shift from Fed and monetary policy to the growth outlook, corporates and margins.
Greg Bodo, the same question I asked Mike Wilson of Morgan Stanley yesterday. Are we going to misunderestimate earnings because we misunderestimate revenue growth due to nominal GDP being sprightly? Is that the singular equity risk as we misjudge the top line?
I personally don't think so. I think that the top line being driven by nominal rather than real growth, I think is well understood. I think more uncertainty lies in terms of the margin forecast. The idea that margins can be resilient next year in an environment where we see a real slowdown in terms of growth and this kind of policy tightening that's already been reflected by a kind of compression in valuations, but hasn't hit the real economy. The idea that that's going to come without margin pressure, I think, is a test. So less focused on top line, more focused on what is the outlook for margins, how deep could the margin compression be, and that's what we think drives earnings.
Relative trade question here, Greg, just to wrap things up. Europe or the US, the Eurostoxx 50 has had such a monster rally off the lows at the end of September, up around about 20%. Which one have you got a little bit more confidence in?
Out of the frying pan and into the fire, I'm afraid, John. I think neither is the answer for us here. We're looking for a correction in both into the next year. The rally that we've seen in Europe has been absolutely massive given the still difficult economic backdrop. You look to the US as a relative safe haven, but the valuations offer you no support there. So we're not bottom fishing in either market as yet.
Great to catch up, Greg, as always. Greg Battle there of BNP Paribas, going into the weekend, and Payrolls Friday just around the corner. European equities have had a massive run, and that's also down to China and this reopening story. This headline just crossed the Bloomberg that the 2023 Formula One Grand Prix in China will not take place due to COVID-19. Now, Tom, the 2023 calendar, F1 not taking place, can you read between the lines there? Can you extrapolate that out to a broader story, do you think?
Well, I don't know about that. I thought Leland Miller was great, and the other Wei Li and the other conversations we've had on China. I'm going to go back to Ed Bastian of Delta Airlines on this show 18 months ago. Said, Tom, international, China, forget about 23. He was dead on. And are we out to 24 now? Are we starting to crystal ball gaze into what do we do in Hong Kong, Shanghai, Beijing, Chengdu, and there's Chengdu is important for a lot of businesses.
We're out to 24 before we even make it to 23. Formula One saying this, Lisa, ongoing difficulties presented by the COVID-19 situation. That doesn't speak to the enthusiasm and confidence people have around the reopening story in China at the moment.
And this confirms what everyone's been saying, that the enthusiasm that people have been having about the reopening story in China hasn't been borne out by facts, and this just sort of speaks to that story. On the other side, international events cannot take place if they don't have any conviction of what that policy will be, and it's clear that that is not currently available.
Very different here in America. We had a state dinner, I believe, Tom. Look at this
list. Was there.
Tim Cook, Brian Moynihan,
Dior, I'm not sure.
Bernard Arnault, Patrick Pouyan of Total.
I went through the list.
Christian Louboutin.
Mr. Colbert was there.
There you go. I know you're a big fan.
Senators, gathered senators.
They all got around and coughed on each other.
It's good. They should do it more often.
The contrast.
I don't know how many.
We should do more of this. We should do more state dinners.
We should have been
That's
with
your
team
takeaway.
coverage.
Yeah. We should have been there. That's your ultimate conclusion, that we should have been invited.
We should have been out with Anne-Marie on the lawn.
It's always the conclusion.
Oh my gosh, she's wearing Hermes.
Oh boy.
Oh, you want to do that? Like one of those Vogue things?
Yeah,
like Met Gala-esque surveillance.
How are you feeling,
outside.
Senator, this evening?
Can you tell us who dressed you? AMH is joining us in a couple of minutes' time.
My dog.
What are you wearing?
This is Bloomberg.
Anne-Marie's like, oh, I gotta...
Keeping you up to date with the news from around the world with the first word, I'm Lisa Mateo. Traders are waiting today's U.S. jobs report to see if it provides any clues on the Federal Reserve's next move. The job market is starting to cool off, but the report may fall short of the turning point that officials are seeking in their battle to beat back inflation. The median estimate says the economy created 200,000 jobs in November. The Pentagon reportedly is considering a major expansion for training for Ukraine's armed forces. According to the Washington Post, the plan has been discussed for weeks by Defense Secretary Lloyd Austin and other top U.S. military officials. It could lead thousands of Ukrainian troops to be trained by U.S. forces at a base in Germany. Economists say China's top leaders are likely to signal a more pragmatic approach toward COVID controls at an upcoming meeting. They're also expected to put more focus on boosting economic growth. The 24-member Politburo usually meets in early December to set broad outlines for economic policy. Beijing has been signaling a decisive shift away from its COVID-0 policy. Global news, 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
To name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but you know, some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city, it's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It's the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become chief future officers. The cruise industry shut down during COVID. Now, CFO Naftali Holtz has Royal Caribbean full speed ahead.
Our goal is to get back to the balance sheet we had. This business is very resilient.
Watch Chief Future Officer, Wednesday on Bloomberg.
We're in the early stages emergence of a sustainability revolution that has the magnitude of the Industrial Revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority. Today, all eyes are on the jobs report.
Jobs report Friday is going to be huge.
It's the final stretch of 2022.
Is there actually going to be some change in the tone?
Wage data might be more important than the CPI.
Today, Tom, John, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
The labor market is stronger than people have thought it would be.
The recession is not here yet, but the check is certainly in the mail.
We're going into a downturn at full employment.
The November Jobs Report, today on Bloomberg Television and Radio.
Prepared to speak with Mr. Putin if, in fact, there is an interest in him deciding he's looking for a way to end the war. He hasn't done that yet. If that's the case, in consultation with my French and my NATO friends, I'll be happy to sit down with Putin to see what he has in mind.
The President of the United States, alongside the French leader yesterday, going into a state dinner. We'll pick up on that in just a moment. Going into payrolls about 2 hours away. The state of play in the equity market looks a little something like this. Up on a week, on a session, pretty flat. Down about 0.1% on S&P 500 futures. 10-year yields lower on the week. 2-year yields down by 27 basis points on the week so far. Pretty phenomenal move lower off the back of Chairman Powell. We'll get to that in a moment. Euro-dollar, more dollar weakness. Euro-dollar right now, 105.35. We have got to talk about unions, just briefly, Tom.
Yes.
The President of the United States said this back in 2021 on Labor Day. He said he intended to be, quote, the most pro-union president leading the most pro-union administration in American history. If you don't support the right to strike, can you proceed to make that claim, Tom?
This is steeped in the history of America, and basically they have reduxed 1877, 1946, right after World War II, and there was a period in my youth where the same thing happened. The bottom line is there is a tradition of government intervention with the rails, and we had at this time, much like previous auto strikes, where the rail laborers, union members, don't agree with their union management. They voted, the Senate, the House, the President has stepped up for union management, not the rank and file.
Here's the question, Tom. What leverage do the workers have if they don't have the power
to walk away? I do not know the answer to that.
And what does this mean for future negotiations and this administration's role in them?
I don't know, and I think it lends importance. We're going to do a Jobs Day interview with John Farrow with the former mayor of Boston, Martin Walsh, who started out in Dorchester and Southie in union management. And I'm going to guess this Jobs Day really doesn't matter with the secretary today. It's about...
He's going to have a lot to say on this, sure.
Yeah, absolutely.
I'm looking forward to it. I think about 9:45 Eastern time.
There were unions last night represented at the state dinner as well. Let's do that with Anne-Marie Horton right now, and we'll get to the serious stuff at hand. I love the theme here, Bonne Nouvelle, that you've got going, Lisa. You know, good news, bad news, Bonne Nouvelle, Mauvaise Nouvelle. I don't know what it was last night, but she was there. Oscar de la Renta at Balmain for years, and Anne-Marie Horton with Pierre Balmain last night. What was the dinner like? Was it a success? Let's start with that. Would Mrs. Onassis, would Mrs. Kennedy have been happy?
Listen, I was not at the dinner Tom is just joking here. I was not at the dinner. Obviously, I've read all the reports out of it, spoke to some people who were inside. It does seem like it was a success. It was on the heels of what I would say also was a very friendly press conference, which I did attend, between Emmanuel Macron and President Biden, where going into this trip, Macron, gave an interview with a U.S. network broadcaster and really came out kind of fiery and punchy about the Inflation Reduction Act and the subsidies and what he would call an unfair advantage for American companies. And it does seem like they walked a lot of that back. The tone was brought down at that press conference. It does look like these two want to work together. At moments, it was almost like a bromance, I think you could call it.
Well, it's like John and me. I can see. It's the same thing. Anne-Marie, very importantly here, this is serious now about the rail strike. In the last 24 hours, the body language is labor lost. Did the rail workers lose yesterday?
In some senses, they do, but we should note that the majority of these rank and file members did vote for that tentative agreement that the administration was able to broker in September. This also came up yesterday in that press conference with the president. He was asked about this, and he clearly was annoyed because the question was to the president, are you saying that members of labor unions do not deserve paid sick leave? And he said, I negotiated a deal no one else would be able to negotiate. And what his point was, I've been working every day since I began this administration, and I campaigned on paid sick leave, not for all, not just for the labor unions, but for all Americans. And also he made a quip that was, quite embarrassing for him to even have to be fighting for this and talking about this in front of a European leader, where this is obviously just the way things are in Europe. You get paid sick leave, you get maternity leave, and the likes. So at this moment, we knew this was going to be tricky for the president because he wants to be the most pro-labor leader. Many would say he has been in modern times, but at the same time, he had to look out for the entire economy and really force Congress to act.
Well, Anne-Marie, let's blend the two stories. The French leader is very unhappy about the Inflation Reduction Act. Within that act, you can get tax credits on EVs that are domestically made. The French leader would like those tax credits to also apply to EVs made in Europe. Now, Anne-Marie, can you walk me through the current stance of this president, and where's Congress on this as well? How are they responding to the complaints from the Europeans?
Well, Congress passed legislation. Do you know how difficult it would be, especially with the Republicans will be taking the House, the majority, next year, for Congress to go back and rewrite legislation so that the Europeans would have a same advantage as the Americans? What U.S. officials will constantly say is that there's just not enough investment in this space, period. So if U.S. companies are benefiting, do something maybe that European companies would benefit on your own home turf. At the moment right now, what the president said yesterday in the press conference was he never wanted to leave folks behind that were not cooperating with the United States, a la France, Germany, etc. But at the same time, he said maybe there are tweaks going forward. There is a task force. Macron in that press conference said that they want to synchronize and have their teams cooperate and look for investments. But at the end of the day, it remains to be seen how this would actually work, because it is legislation, and I do not see that being rewritten.
AMH, down in DC, thank you. Wonderful work. We'll catch up with you in the next hour. Lisa, I don't think anyone wants to go back over that in the United States, and the complaints from the Europeans are just going to keep on coming through.
How do they then come to some sort of agreement on some of these other bigger issues, whether it's China, whether it's other types of dealing with Russia? You're right. I don't think people are going to want to do that in the U.S. How do you muddle through? This is a muddle-through president who's trying to come up with practical responses, even if they go against the ideals. How does he do that in this particular case?
Can I switch gears to a Wall Street issue?
Do you ever ask permission to do that? Usually you just,
in the therapy we did yesterday, John, I'm trying to be more sensitive and more vulnerable. Can I switch gears?
Of course you can.
Blackstone, this is not a small issue.
Okay, the gating. Walk us through this.
This is not Credit Suisse. I want to say that from the first. And Blackstone was heated to the FT yesterday. They're giving substantial returns of 9%-ish in their returns. Srinath Rajan and Don Lim at Bloomberg moved the story forward. And basically, Asian investors in their real estate fund want to take their money out for whatever reason, and they buttressed up against those limits. This is stock down 8%. It was not a small issue.
You know what the question that's being asked, right?
Right.
Summer of 07.
Yeah.
The funds, was it BNP?
Vince
are we doing that kind of thing again?
Brought this up yesterday. He's like liquidity out there, 2023. Yeah, it's not a small issue.
We'll breathe some life into the
Was
story
I
through the
there?
morning.
Was that okay? How
That was beautiful. Thanks for asking for permission.
That's it for the day.
That's a new thing.
get stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
The payrolls report, 2 hours away. We're looking for something like 200K in the November payrolls report. That's the median estimate in our survey. The range is pretty wide. Equity futures going into it look like this on the S&P 500. Slightly negative through much of this morning, down 1/10 of 1%. On the Nasdaq, down 2/10 of 1%. On the week, up on a week on the S&P, heading for a second weekly gain. In the bond market, 2-year yields down on the week by more than 20 basis points. You can thank Jay Powell for that. We're down another 3 or 4 on a 2-year to 4.1912 on a 2-year yield, TK. As Chairman Powell sounded very different to the Chairman Powell we heard in the news conference a little more than a month ago.
My head's spinning. Did we learn anything from the 14 Fed speakers yesterday? I don't think.
Do you want the good news? Yeah. Blackout period starts tomorrow.
Okay, well, yeah, that's a benefit to the chairman, to say the least.
No Fed speak after today.
And we're all together for December 14th, right?
We are, but they've got the semi-final of the World Cup at
Well, I was going to say, Lisa, what do you think? It's you and me for
as
the
Fed
meeting?
decision comes. I mean,
Cheryl,
you get
I've got COVID. I can't come in.
What, twice in a month?
1 day COVID.
You get 50% Faro on the semi-final day. I'll do the Federal Reserve decision, and I'll watch the football on the side.
Did you watch Japan yesterday?
I did, yeah.
What do you think of the VAR goal?
I was too screening.
The end line?
I don't think FIFA shared enough pictures as to why they made the decision they ultimately made about whether the ball crossed the line or not.
Yeah, okay.
But they've got the technology. It clearly, for them,
they just didn't show
cross
it
the
to
line.
the audience.
I don't think they demonstrated sufficiently for the audience. Okay. And there was one camera view that made it look like the ball had crossed the line.
Michael Dard is like, why am I on this show?
Because it's his birthday. It's Mike Darda's birthday, and this is a gift being on this show, Tom, on Payrolls Friday.
It's a gift to us as well on Payrolls Friday. Michael Dard has been such a supporter of what we've done through the years. Rumor is he's getting a third dog, and we'll see that out on Twitter. Mr. Darda, thank you so much for joining us today on Jobs Day. I want to do an Austin Goolsbee take, who's going to take over at the Chicago Fed, which is you guys toss around a lot of Latin, like ex ante, where you're out front of whatever the decision is, and ex post, where you have to wait, and that's the traditional mode of any central bank. As we go through the Fed process, linked to this jobs report, linked to the inflation report before the Fed meeting, is it delusional to think the Fed can get out front and make a guesstimate, or do they just simply have to wait for the data?
Well, I do think that they are going to be data dependent, continuing to look at the data closely, but they can get out in front a little bit more by looking forward. And what I mean by that is we're starting to see signs of incipient labor market weakness in an array of forward-looking indicators. For example, the 4-week average on first-time jobless claims is moving up again, and it's well off the lows of the year. If we hold at current levels by next spring, we'd actually have a recession signal out of that data. The Conference Board released some confidence numbers this week And within that index, there's a measure of households that say jobs are plentiful. Leading indicator, that's been rolling over. The quits rate has been coming down, albeit from high levels. And so we're getting more data now that's suggesting the labor market is losing steam, but that's the intent of the Fed. So this is what they want, and I think this is what they're going to get.
What is our history of seeing and predicting a recession? The last 12 months, I suggest, many have been off the mark in their gloom. Can we actually get out front of a recession, or do we just simply have to wait for NBER to tell us it's here?
Yeah, well, NBER, they will confirm, but they don't. They're not in the business of making forecasts, so it'll already be obvious that it's going on by the time they make that call. This year was confusing because we got 2 down GDP quarters, and a lot of people thought that that meant there was a recession, but the NBER came out and said, actually, that's not how we do it. So we had strong jobs growth. We had a falling unemployment rate into the summer. And so those things have never been associated with with an actual recession. If we're thinking about 2023, where you have the unemployment rate start to rise, that's a totally different animal. And there is a lot of talk about recession now. That doesn't mean it isn't going to happen. I think the risk is actually quite elevated. Your team there has done a great job covering the yield curve inversion that's been going on this year, and it's recently broadened pretty dramatically. I think even now the Fed's measure of the near-term forward spread is pretty significantly inverted. And that is probably the best forward-looking signal of an impending recession that we have. The problem is, if you look back in history, the lags vary pretty significantly. So there'll be no way to time it precisely, or what all our clients ask is, tell me the exact depth and duration of the next recession and when it starts. And, I wish I could do that, but, it's really guesswork.
So, Michael, you expect inflation to keep going down. Do you still believe in transitory, or is this a different nature of a decline in inflation?
Yeah, I do think headline inflation is going to come off the boil pretty rapidly as we move into the middle of next year. But unfortunately for Team Transitory, I don't think that is going to bail them out. So that phrase was used back in 2021 to mean that inflation was really non-monetary, that it would probably only last a few months, when in fact the inflation was the result of the Fed going into a hyper-accommodative monetary stance, and then at least initially being dilatory and starting to reverse course. So the inflation intensified and broadened. But I think the Fed is caught up now, and we're talking about the yield curve. I think you could even argue that they're in a somewhat restrictive stance. So growth will slow, inflation will roll over with a lag, and that's where we are. So it's not going to bail out Team Transitory, but this new argument now, I'm calling it Team Structural. I think that's going to turn out to be
okay. And that rebranding does not work. I'm sorry, but nice try. Michael, I'll give it to you because it's your birthday. You're talking about how the Fed might already be restrictive, and that's not consensus at all. And that's what you're not seeing in terms of the market. If the Fed backs away or even just doesn't raise rates as much, you get a rip-roaring rally as people pile back into risk assets. Does that concern you, or does this seem consistent with your view of the path of the economy and the path of inflation?
Yeah, that's a good question. The Fed is worried about so-called financial conditions loosening up. And so if they signal a step down in the pace of hikes and interest rates pull back and equities move up, that's not necessarily what they want. But I think the Fed is, put itself in a box here if it's simply going to be responding to equity market moves. It really depends on what's happening to inflation expectations at the same time. And if we look out the curve on inflation expectations at the 10-year horizon, we're in the 230s. Because those are based on the CPI and not the PCE deflator, and the CPI runs 20 to 50 basis points higher on average, you could argue those are mandate consistent levels. And so if the Fed is stepping down the pace or starting to reverse course on policy, and those inflation expectations really rise materially, then the Fed should pay attention to that and respond. But it can't just be a stock market story, in my opinion.
Michael, if we look quintiles, 1/5, or deciles, 1/10 of the labor force that we see at 8:30 today in the two reports, Are we aggregated? Can you look at the holistic view of the American labor economy? Or out of this pandemic, are we so fractured, fragmented, polarized that it's different labor models at hand? Can we aggregate or not?
Yeah, I think we can aggregate. I mean, obviously, we had a lot of distortions in the labor market and other parts of the economy from the pandemic. And it does look like we've had some early retirements that may not be coming back. But this labor market has, for all practical purposes, fully recovered. It's very tight, but it is losing steam at the margin. And I would just say to the viewers, watch the unemployment rate. It is coincident to slightly lagging, but it's probably the best single summary variable that will tell us when a recession is ongoing. And it's not going to predict a recession. We need the yield curve and other forward-looking measures for that. But if the unemployment rate levitates 0.5 percentage point or more from year earlier levels, and that's, basically going to be 4%, or a little bit more, that would be a really strong sign that the U.S. economy is either on the cusp of a recession or a few months into a downturn. It's never happened in history. I think it came up in a discussion earlier today on Bloomberg. Could the unemployment rate rise 1% or 1 percentage and a point and a half and stop? Never happened in post-war history. Anytime we've gone up 0.5 percentage point from year earlier levels, we continue to rise in a recessionary fashion. And in the smallest increase post-recession trough to recession peak, pre-recession trough to post-recession peak has been about 220 basis points. The median is just over 300 basis points. So a mini recession is possible, but you're really arguing against the historical track record.
Hey, Mike, happy birthday from Team Surveillance.
Thank you.
Thank you, sir. Michael Dowder there of MKM. Just want to draw your attention to Credit Suisse. Session highs in Swiss trading. The stock is up by 7.5%, coming off the back of a record 13-day losing streak. Francine Lacqua catching up with the Credit Suisse chairman a little bit earlier this morning, Tom. And the chairman told Francine that the Swiss lender had seen withdrawals basically stop. So have the outflows stopped at Credit Suisse?
Yeah, 13 days down the row. I mean,
it's been brutal. Still got a two-hander.
I have real trouble with a 7% move. In fact, maybe it's walking from the bid over to the ask, away from the actual published number. The answer is it bounced a little bit at a grim level near that dilutive calculation when they don't go out and was it 4 gajillion they're doing?
Lisa, they're hoping we've seen the bulk of the bleeding through October and November.
Let's go directly to his
Sure, I'm with you. I'm with you.
When I speak to clients, I already know that there are going to be inflows. On one hand, he has to calm the markets. On the other, the specificity of this, if it is not proven in the data coming up, that's going to be another story that he's going to have to face off with. This is more concrete, which is the reason why shares are responding.
The Credit Suisse right now up 7.7%, but still trading with a two-handle. It's Swiss trading.
That's the key.
It's pretty ugly stuff. Coming up, Diana Amoa, CIO for Long Bias Strategies at Kirkoswald Capital Partners. Looking forward to that conversation. Been a while since we caught up with Diana.
Yes.
It's Payrolls Friday, 200K is the estimate. From New York, this is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. The Kremlin says Vladimir Putin will continue military operations in Ukraine, but it adds he's open for negotiations. A Putin spokesman was responding to President Biden's remarks that he would meet with Russia's president, but only if Putin indicated he was looking for a way to end the war. In South Africa, leaders of the country's ruling party are meeting today, while the fate of President Cyril Ramaphosa is up in the air. He's said to have considered resigning after an advisory panel found he may have violated the Constitution. The panel investigated Ramaphosa's alleged failure to properly report a robbery at his game farm. In the wake of the collapse of FTX, former FDIC Chair Sheila Bair says U.S. regulators have enough power to oversee cryptocurrencies. And she said a crackdown is needed so banks know where they stand.
If a business is legal, then to tell a bank not to have dealings with them, I think is hard. And I am unaware that any of the entities doing business with U.S. banks were illegal. So I think it's hard. It's a very controversial issue to try to use insured banks to shut all of this down.
U.S. authorities have now ramped up their investigation of FTX and are asking those who use the exchange for information. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Suppose somebody is watching and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Until I see our actions actually having some impact that would lower the rate of inflation, I think that my expectation would be that we would have a slightly higher rate than I had anticipated in September.
Michelle Bowman of the Federal Reserve. More Fed speak still to come a little bit later. I believe you hear from Barkin. and Evans, and then it's done. It's the quiet period. It begins tomorrow. I know many of you are happy about that, going into the Fed decision on December 14th. Before we get to the 14th, we've got a payrolls report a little bit later this morning, and then we've got CPI on December 13th. Going into all of that, equity futures on the S&P down a little more than 0.1%. Yields unchanged on a 10-year. That classic kind of payrolls feel, Tom, ahead of the number. 350.98, we're going nowhere. Euro dollar going nowhere. 105.30. Crude going nowhere. $81.25.
Yeah, we had a lot of interest this morning in Maria Tadeo. With Spain losing yesterday, I can report that she's being monitored in Brussels and is improving. We've seen that.
You know what she said to me last night?
Hours.
Maria WhatsApped me last night, and she said that Spain chose to lose deliberately so they could get into the weaker half of the draw.
Did she say that?
Argentina.
They sandbagged.
That is the official stance of Maria Tadeo. That Spain lost deliberately.
It was critical there for a moment, but she's improving, and we're thrilled to bring it out today. It was being monitored as we speak. What you need to know, folks, we're going to let John bring this up, because what you don't see when we're on commercial break, and I wish we do, like, you could see us talking and all that, and then show the message. And we thank our great supporters of Bloomberg Surveillance every day. But it's one nonstop World Cup talk. Continuing our World Cup discussion, Diana Omoa joins us now, hugely qualified in the equity market. But John, pick it up with Diana about the path England has from Senegal to France and beyond.
It's a tough path now, because they've got Spain.
Do they have the toughest path of anyone?
They've got to get past France, Spain. If they progress and those teams progress, and then ultimately it could be Brazil or Argentina in the final. But given how things have gone so far, I've got no idea. And I imagine Diana has no idea either. Diana Omoa, the CIO of Long Fire Strategies at Kirkoswald Capital Partners. Diana, a proper introduction for you, because you deserve one. Can you walk us through this market, Diana? Because I keep hearing from a lot of people who expect this earnings weakness to punish equities in Q1 of 23. You on the same side of things with those guys?
I think it certainly deserves a little bit of consideration as we go into the year, particularly given the rally we've had the last 2 months. I'd say markets were probably better positioned for the weaker data that we had a couple of months ago. I think the short squeeze that we've seen as a result maybe speaks that positioning was extended. While the US data has been slowing down, it's not slowing down fast enough, I think, to justify some of the bearishness we had in the extreme. That said, going forward into 2023, I think the outlook might be somewhat more challenging. From the US perspective, we're already seeing signs that there is an element of consumption that's starting to slow down somewhat in the US. And additionally, I think given where we are from a valuation perspective, it's a less attractive market to be owning if the concerns around earnings slowing down more aggressively into next year actually plays out.
I still don't understand this, Diana. Everyone who comes on says that it's going to be okay for a couple more weeks, and then we're going to see the earnings per share, and everyone's going to sell, and it's going to be terrible.
We're dead on.
This is a forecasting instrument. It is a forward-looking instrument, the S&P. The people who are trading should be looking forward. If everyone's seeing the same thing, why are the prices not reflecting it?
100%. I think it's you can usually call the direction right or the timing. It's very rare that you have people getting both the timing and the direction right. And whilst there's a lot of concern around earnings, justifiably so, whilst everyone is talking about it, in my experience, it seldom plays out timing-wise. So there is a chance that this ends up being one of the most frustrating bear market rallies we've seen, because the timing doesn't quite play out as people expect, i.e., come Q1 next year, we may not necessarily see the kind of price action markets are discussing. And that might take longer to play out.
I'm watching the 10-year yield, though, and this has been really the one consensus trade that has done well. I'm looking at yields about 3.5%, down about 70 basis points from a recent peak. As recently as just a couple of weeks ago, I'm just trying to understand how much further this can go if everyone's on the same side of the trade and equities aren't buying into the same story.
So that's the disconnect we have right now, because we've had this aggressive inversion of the yield curve that's playing out. As we've seen, the 10-year has come off quite aggressively off the highs. So the bond markets are saying we're heading into a recession. Now, typically that tends to happen between 18 to 24 months of curve inversion. So what we're really saying, if you go by what the bond market is telling us, is a recession is more of a second half of next year trade rather than a first half. And I think equity markets are hoping that between now and then, you will get a real Fed pivot, i.e. not slowing down hikes from 75 to 50, but actually the Fed saying, we've stopped hiking now. We're mindful that the economy is slowing down perhaps faster than we'd anticipated. And if indeed that plays out, we will actually start to ease. I think that's unlikely, but it feels the equity markets are really much more poised for a pivot than the bond markets.
Diana, if we get inflation sustaining at a certain given level, which gives us some form of decent nominal GDP, can that save equities? Can that save revenue growth, revenue persistency, and cash flow persistency?
I think it could help. But ultimately, if you have high inflation that's supporting nominal growth, but the labor market is starting to show signs of weakness, I think markets will react to that, because at the end of the day, it's really the consumer that's been keeping the economy ticking along. Yes, business balance sheets are much more resilient than they've been. And I think COVID did help to that extent in terms of getting companies to think about refinancing and also getting rid of some of the weaker balance sheets that had been in the market. But if you start to see labor weakness, which is why I think the data today is going to be quite key, I think that could be much more meaningful and impactful for sentiment.
Diana, what do you think is the most important number today? Is it the headline number or is it wages?
Without a doubt, I'd say wages. The headline number has been somewhat noisy. If you recall, last month we had that higher than expected print, which people are still trying to grapple with on what was coming through in that data. There are some inconsistencies in some of the subcomponents. I think the earnings is probably what markets will be watching for signs that we are starting to see some ease in the labor markets, that the labor market inflationary pressures are not becoming entrenched. And that's something the Fed has said is a big focus for them. So they don't want to see the second round wage spiral.
Diana, it has been too long. Don't leave it so long next time. Diana Rameau there of Kirkoswald Capital Partners. Wonderful to catch up, as always. Next hour, fantastic lineup. Priya Misra of TD coming up in about 5 minutes' time. Then after that, Ellen Zettner of Morgan Stanley will catch up with Ellen Tom at around 7:30 Eastern Time.
Did you see Ferroli of JP Morgan in at 150, published 150 survey?
Sure.
There's a real,
Went through the numbers this morning,
There's a whole group of people south of Ellen Zettner. I believe she's at 180.
Do you want the full range? The full range, the highest 270,
but yeah.
The highest 270, the lowest 60. Yes, you 60. Do. Yes, you do.
Okay. Yeah, I don't know. I'm with Diana. I'm looking at wage dynamics seriously. And
You're not alone.
Lisa's been great on labor participation. I'm in the camp, Lisa. Labor participation is a fiction because of demographics and social policy. The world of Austin Goolsbee, we don't have a clue what the labor participation is.
But if it doesn't change, that means people aren't coming back. And that was sort of the best case scenario for the Fed.
It's a disincentive to retirees to unretire and work with Pharaoh. I mean, that's what...
What are you suggesting?
Therapy is definitely not working.
What are you suggesting?
I don't know what I'm suggesting. Don't talk to me like that.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. We had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
We're in the early stages of a sustainability revolution that has the magnitude of the Industrial Revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority.
There is an extremely elevated chance of recession.
The Fed's got to pray that the labor market quiets down.
They're going to go gradually. They're going to watch what's happening in response to what they've already done so far.
The catalyst for the next bull market is when the Fed actually starts cutting interest rates.
We have more confidence that this rally will continue into December.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It is Payrolls Friday, 90 minutes away, live from New York City. This is Bloomberg Surveillance. Good morning to you. With Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. TK, the number we're looking for today, 200K.
We're having a light Friday about it, but this is serious stuff because all of a sudden, as we heard from Michael Darda, the data's getting a little nudgy here. There's a little tension in this. I'm sorry, I'm in the camp CPI in a couple days here is more important, but nevertheless, the tension's there this morning.
What have we had so far? ADP? Wasn't impressive, was it? Manufacturing a little softer, a whole lot softer, in fact. Looking at the ISM yesterday, the employment component of the ISM, Lisa, not great. You wonder if this starts to show up in the data a little bit later.
It also points to the political pressure next year. We haven't even seen the unemployment rate rise. We're seeing a little bit of softening from the highest levels in 40 years for inflation. And all of a sudden, people are saying the Fed needs to stop. They're going to crash the economy. I mean, just to talk about a little bit the shift in tone really highlights the conundrum next year for the Fed.
And I asked Darda, do you aggregate this morning at 8:30, or is it about different parts of America? John Edwards of Louisiana's 2 or 3 or 4 Americas. I'm not aggregating. I think there's some people out there, John, in real pain.
The move has started in the bond market on a 10-year and now the 2-year. The last time we had Payrolls Friday, about 20 minutes after the number came out, we were pushing 480 on a 2-year. We're back down to 420 with a big move this week after Chairman Powell.
Both of you follow this much more than I do. Is anyone out there framing a 330 or 320 10-year yield?
Yes.
I would say no one. Are there people modeling recession-like rates that much forward?
Brian Weinstein of Morgan Stanley. He said that he expects the 10-year yield to go down to 3.25% by the first quarter of next year.
John, she says it. She cuts. Tom, you don't know what you're talking about.
Well, you missed the conversation with Brian earlier this week. You took the day off.
That's sabbatical.
I know.
Yeah, I got some
well, Lisa's pretty brutal sometimes if you've missed stuff. She expects you to be up to speed on interviews you haven't seen.
We declare the living room for the tree.
So do I go to therapy next time, too?
Just so everybody, just so you understand, at Bloomberg here, in the Bloomberg family, no one tops Scarlet Fu. I mean, Scarlet
when it comes to the tree.
She's out
Next
there.
level.
She's like north, not to Albany, but she's north somewhere. and the ceiling is like 30 feet tall.
Oh, she's doing like the 15-footer thing.
It wouldn't fit in the White House. It wouldn't be their thing. Oh, she's
one of those.
past 15 feet.
Well, like 20 feet.
Yeah, they got a crane and everything.
They do it outdoors.
Yeah.
Equity
Oh, it's
futures
indoors.
look like this on the S&P 500 going into payrolls, 8:30 Eastern time. And our survey moving target, of course, going into the number. But the median estimate so far is 200,000. Equity futures are down a couple of tenths of 1%. We are down on the session. We are up on the week in the equity market. Yields at the moment up on a session, down on the week on a 2-year. Tom, I keep going back to this on a 2-year right now.
Yeah.
Down on the week by more than 20 basis points after Chairman Powell.
And we disinvert from negative 80 gloom and all that to negative 75-ish and now negative 69 on the 2-cent spread. Less inversion than what we saw in the gloom of a week or so ago. And John, the real yield, are you doing the real yield this afternoon?
I'm not, no.
You can't. Brazil's playing.
I know. I'm busy watching football.
The real yield is a stunning 1.14%. Can you imagine the 10-year real yield under a positive 1%?
The 2-10's backing away, Elisa. The 2-year versus the 10-year, negative 68 basis points this morning.
Is the data bad enough to really give people a sense that this is warranted? 8:30 a.m. we get the labor market report for the month of November. How much do we get a sense of the hourly average wages coming down rapidly? How much is enough to really give people and that transitory crew, which have not gone away, just to be very clear, some steam? And that is what I'm going to be watching. 9:45 a.m. Very curious to hear this conversation, John. You're going to be speaking with Labor Secretary Marty Walsh, talking a lot about, I'm sure, the rail strike. How does he talk about their support of unions from this administration, plus a mandate from this Congress that they get on with it and pass a bill that the union would not ratify? A real tension underpinning, I'm sure, what you're going to do a wonderful job talking about today. And we get a host of Fed Speak, the last Fed Speak before the quiet period. Richmond Fed President Thomas Barkin and Chicago Fed President Charlie Evans, one of his last addresses before he retires in January, taking over Austin Goolsbee of the University of Chicago, who has a bit more of a hawkish tilt, John. It's sort of interesting if you look at some of his proclamations and readings ahead of time. Going to be an interesting voting voice on the Federal Reserve.
Sometimes the seat can change you when you get in there, Tom, and you sit around the table.
Strongly
the seat
agree
can
with
change
that.
you.
become a public visible officer.
It's going to be interesting to see how the seat
changes.
might change him.
Well, Professor Goolsbee, we'll talk about that with Mr. Krosner. We're gifted to have Krosner with us today.
Priya Misra joins us right now, the global head of rate strategy at TD Securities, as we like to say, Tom, the queen of interest rates.
Let's just killed
fantastic
it this year.
But the trades have come off, Priya. So you went long the 10-year at 425. You took that trade off at 370. You put the flattener on looking for deep inversion, negative 40, 50, 60. We went further. That's off too. Priya, what's left?
So I have to say I'm very nimble in terms of trades right now. I mean, it's, I have the direction of still lower rates. It's just we've come so far so quickly. I think the markets misinterpreted the Fed a little bit. I think the recession is our base case. That's going to mean more cuts will happen in 24. That means that the 10-year, our forecast for the 10-year at the end of next year is 3.25. But we've moved really fast. So, I think you have to be nimble in this market that's not very liquid, that's extremely volatile. I think you have to trade in a nimble fashion. I will look to go long again. If we sell off a little bit, we realize that the Fed will be forced to keep hiking. We think the terminal rate is going to be higher than where the market's pricing it in right now. So I think I'm trading it in a nimble fashion. It's the timing versus direction. But the direction, I think, is still lower rates. And unfortunately, a Fed that's going to be forced to keep hiking because inflation is going to be really sticky.
Priya, it's surveillance. We always listen to our guests who get it wrong and get it right. The hardest thing is to get it right 2 years in a row. I think of Ellen Zettner, who'll join us later at Morgan Stanley, has nailed that. Nick Benenbrook at Wells Fargo and Foreign Exchange, and now you. The call that you're going to make for next year, are you going to get the suddenness of it as we got with inversion? Is it stochastic? Is it pointing where, boom, we disinvert?
So I think that's the key question. At what point do you put on steepness? Do you start betting on Fed rate cuts? And that's the question I keep getting from clients. I think not yet. I mean, it's all going to come down to inflation is going to decline, and that's in our base case. How quickly is it going to decline? And does it get sticky at 3%, 3.5%? And we don't think the Fed can start to ease if inflation is at 3 or 3.5. So I think you stick with that inversion trade. The inversion will last much longer than what we're used to. The economy is going to slow down. We're all going to look at the Fed to ease. And I think they're going to stand pat as they're telling us. They want to be restrictive for a while. So I think the time for the steepener is much later in the year when inflation has, sufficiently come down, at least 2 handles somewhere before the Fed can start to cut. So I think you just trade the flattener when it steepens a little bit, you put on the flattener, as opposed to really talking about disinversion. I think actually requires the Fed to start to ease. And the labor market is still very tight. That's what we're looking for today. But watch wages. I think actually that's more important than the headline number. That's what is going to drive core services inflation lower if wages start to come off. And I think it's still too early for wages to come off.
Given that is actually a popular belief among many people, do you think that the 10-year yields and the rally that we've seen, frankly, across treasuries this month has been a bit overdone?
I think the speed of it, I do struggle a little bit with. I mean, we thought more cuts should be priced into 24. We went from 100 basis points of cuts to almost 200 in a short period of time. I think the market's pricing in recession. I actually think that's right. I mean, I expected that to happen as we got much weaker data. It's happened faster, so it can actually now stabilize here. What I struggle with is the easing in financial conditions, or this idea that the Fed can stop at 4.8 on the terminal rate. If inflation is going to be sticky, I think the Fed hikes 50, in 2 weeks' time. Then they hike another 50. Then they continue to hike, maybe at a slower pace. It's the end point of the hiking cycle. I think the market's a little optimistic. I think Chair Powell didn't push back against the easing in financial conditions. I think that's what the market took relief in. So the front end rates, I think, can rise. That can pull the 10-year a little bit higher, which is why I took off the long. But longer term, I think the recession is sort of, I think it's baked in the cake at this point.
Just want to dig into that a little bit more, Priya. If you believe the recession is baked into the cake and you think maybe we're still underestimating how far this can go, let's use this morning as a case study. Let's say we get an upside surprise on payrolls. And I think we all understand where the 2 years going to go in that world. Yields higher. Priya, why do you think that you push that out through the curve, out to 10s yields up, and not push it out through the curve and think, you know what, the Fed's going to go harder, I'm going to get that recession that I'm expecting, yields lower? What is it that makes you think you push 2-year yields higher out through the curve and yields up off the back of a payroll surprise?
I think if you get a strong number and strong wages, it's going to imply that the Fed has to hike more. And then I think people look at, how much can they cut? If inflation is high or wages are high, that's going to constrain the Fed's ability to ease. And now we're pricing in almost 200 basis points of cuts between, mid-23 and mid-25. I think people are going to struggle to price in more cuts. If inflation is high, the Fed is going to be constrained in terms of how much they can cut, which is why I think that inversion stays constant. And if the front end sells off, I think the 10-year also sells off. It's only when inflation starts to come off, and that's why you see the last CPI report, more cuts got priced in, because people realize that the Fed has a dual mandate. They're elevating inflation right now. But, if growth starts to weaken and inflation is still high, they're going to be in a real tough bind, and they may not be able to cut as much. So it's really this pricing in of easing. At 100, I was pounding the table saying more cuts can get priced in. At 200, it starts to look a little tougher for them to keep easing.
Priya, thoughtful stuff, as always. And I think we've said it a million times this year, but congratulations on just some phenomenal calls through 2022. Priya Misra there of TD, going into payrolls. Payrolls, Tom, 1 hour, 20 minutes away.
They amend along the way. This is something I think the financial media really gets wrong. We want to look at a single point estimate and go, you were successful, you failed. Baloney. It's how you amend along the way. She had an aggressive call and then amended it beautifully.
Taking those trades off. Anne-Marie coming up later in DC in about 5 minutes' time. Do you know who's not? Maria Tadeo took the day off, Tom.
No, but
took the
we'll
day
do
off
it after the
because
break.
Spain lost.
But, really terse comments from her. She's resting comfortably.
Because Spain lost.
They did it on purpose.
Sent us an email moments ago. Maria had a long planned day off today. Do you like how she did that? Maria, from Maria. Yeah. And did a full debrief with Ferro yesterday on WhatsApp. First half good, second half bad, but strategically better for Spain. No Brazil, no Argentina in the knockouts.
She didn't ask me for a debrief.
Beyond that, no comment.
I want a debrief. Lisa wants a debrief. What do we? We don't get the Tadeo debrief.
The official breakdown from Tadeo there. AMH coming up next from Washington. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Pentagon reportedly is considering a major expansion in training for Ukraine's armed forces. According to the Washington Post, the plan has been discussed for weeks by Defense Secretary Lloyd Austin and other top U.S. military officials. It could lead thousands of Ukrainian troops to be trained by U.S. forces at a base in Germany. Traders are awaiting today's U.S. jobs report to see if it provides any clues on the Federal Reserve's next move. The job market is starting to cool off, but the report may fall short of the turning point Fed officials are seeking in their battle to beat back inflation. The median estimate says the economy created 200,000 jobs in November. Shares of Credit Suisse have rebounded from record lows. Chairman Axel Lehman told Bloomberg the bank has mostly stemmed the huge outflow of client assets, which surged to about $90 billion earlier this quarter.
The outflows basically have stopped. What we saw is 2-3 weeks in October, boom. And since then, flattening out, they have stopped. It's gradually coming back, in particular in Switzerland.
Credit Suisse is pitching investors on a capital raise it needs to finance a major overhaul. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. Even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that this is something that many business leaders are focused on, and time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at a 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and we'll continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
with unmatched reach and resources from more than 120 countries. The moment news breaks, 24 hours a day. Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Hey, all eyes are on the jobs report.
Jobs report Friday is going to be huge.
It's the final stretch of 2022.
Is there actually going to be some change in the tone?
Wage data might be more important than the CPI.
Today, Tom, John, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
The labor market is stronger than people have thought it would be.
The recession is not here yet, but the check is certainly in the mail.
We're going into a downturn at full employment.
The November Jobs Report, today on Bloomberg Television and Radio.
This inflation is being caused because of unbelievable wasteful spending in this government. We have got to start saying to ourselves, we're at $31 trillion worth of debt. When do we stop? Is 35 too much? Is 40 too much? 45 too much? We've got to put we've got to be a brick wall to this government spending at some point.
And that is Rick Scott of Florida. He is the Republican senator, and that is the story that you see in Washington. There is a different story, and it's not the joy of a state dinner last night that we saw, John. It's still this growing tension between the President of the United States and Mr. Putin in this war in Ukraine.
Interesting that the president is open to having some kind of talks, and we're hearing from Putin this morning through Dmitry Peskov, the Kremlin spokesperson, saying this morning, Tom, quote, Putin was and remains open for contacts for negotiations. Of course, the best way to achieve our interests would be through peaceful diplomatic means. Now, it's not the first time we've heard this kind of talk, Tom, but certainly this aligned with what we heard from yesterday. I think we'd all like to hear much more of it.
We needed an update, and we do that with someone who was in Vladivostok, whatever it was, on the west coast, the Pacific coast of Russia years ago. Anne-Marie Horton joins us now with her Putin experience. Anne-Marie, we haven't talked about this in ages.
This is in the Far East.
The Far East, yeah, whatever. My map failed there. You know, I played Risk. That's the only reason I know the map. Anne-Marie, long ago and far away, Mr. Putin had power. Has his power changed just over the last 90 days?
Oh, I think incredibly his power has diminished on the international stage for sure. You even see the likes of Xi Jinping of China. I think, you know, the statements coming out of the G20 from the White House readout of that meeting with Joe Biden, you obviously saw the Chinese sending more signals that they're a little bit uncomfortable and clearly unhappy with what President Putin is doing. Internally, though, it remains to be seen, right? Because he still is able to have control of Russia. But what you do see internally from Russia, and even I've witnessed, is a mass exodus. It is a brain drain of numbers of people, those that are highly educated, and also young working men who do not want to go fight this war. And this is something that is going to inflict a lot of pain on their economy over the next 6 to 12 months.
Bring it back domestically to the gentleman from Florida, Mr. Scott, or the governor of Florida, Mr. DeSantis, and their battles within the Republican Party, or Mr. Biden's Democrats. Do they support the president in visiting with Putin or speaking to him?
Well, it remains to be seen. We don't exactly know what their feelings are about that specific comment, but I would say the president caged it pretty well. He said, I have no imminent, immediate plans to speak to President Putin, and he said he only would if Putin was serious about ending this war. And I think you'd be hard-pressed to find someone in Washington who doesn't want Russia's invasion of Ukraine to end.
Does it indicate, though, in Anne-Marie, a greater frustration with this dragging on conflict and a greater desire to get to some sort of end and perhaps move away from some of the arms supplying and other rhetoric that has seemed to amp it up in recent months?
Yeah, and also you have Mr. McCarthy, who's going to be the next speaker, likely, talking about the fact that it's not going to be a blank check going to Ukraine. They want a little bit more oversight. Republicans, and also we saw that letter from progressives that was just honestly kind of weird because they walked it back after they sent out this letter. There is, though, what the president said yesterday, another way to look at this. He was standing next to Emmanuel Macron, who is going to be speaking to President Putin in the coming days. It's on the heels of this morning, a call between Olaf Scholz, the Chancellor of Germany, and President Putin. They had a call this morning, discussed a number of things. Putin, of course, airing his grievances of the West sending weapons and training Ukrainians, but also they discussed the very critical grain deal that the world is relying on, especially the most vulnerable economies, as well as potentially fertilizer coming out of Russia. So the president was in this moment where his allies that he is trying to keep together as a united front are engaging with Putin. And that's where he made this comment.
So I'm glad that you brought up the grain shipments, and I want to go to the oil shipments as well. I was confused by this morning. OPEC slashing oil output by the most since 2020 seems like it would be a real bullish thing for oil prices because it's reducing some of the supplies. But oil prices are up because Russia's output and the amount that's going to come back online next year could offset that. Can you explain this? Basically, is the world getting back engaged with Russia in a sort of stealth way?
Well, Russia is still sending, listen, the lifeblood of Putin's economy is still working, right? He is still sending out natural gas and oil. And what the West is doing is also creating a space for him to do that. There was a sanctions package from Europe that basically said Russia will not be able to ship crude oil anymore because it is going to sanction those companies that are largely European. Malta, Cypriot, Greece. These are where these ships come from. And now they're working on this oil price cap. It will come into play on Monday. The likely threshold that we are hearing is $60 a barrel. Right now, Urals are trading, and this isn't the only grade Russia has. They have other grades that usually fend for higher numbers, but right now, Urals are trading at $52 a barrel, which means that Putin is still going to be able to ship his cargoes within this limit and still make the money he needs to make.
I still do not understand this price cap.
Thank you.
I don't understand the policy. I've heard someone try and explain it to me 5 different times.
I can't even read about it. When I read about it, my eyes glaze over.
I don't get it.
Yeah.
I don't get it at all. Do you get it?
It has to do with ensuring the barrels and sort of the key mechanism to get ships to actually be able to transport this oil and be able to do it without getting sanctioned. And so they're trying to come up with a mechanism to do that.
They take Russian oil, they move it to country X, and then they call it country X oil, right?
That's exactly what's happening.
That's what we've seen all year, right?
I think.
Well, but the irony here is,
well,
but this is the irony, right? Prices have gone up because people think that Russian barrels have gone off market, but they haven't. They've just gone to India, been refined, and then sent to Germany. I mean, this is sort of this irony in the whole situation.
Twice what we know.
Bizarre. AMH down in DC, Anne-Marie, always fantastic.
Yeah.
Thank you. The focus on Washington a little bit later on how the Federal Reserve will respond to some of these numbers in the next couple of weeks. Payroll's coming out in about an hour and 5 minutes from now. The estimate is 200,000. The previous read was 261. But you ask guests in a moment, Tom, what do they want to see? Payrolls or wages? I think up front right now, they take that wage figure.
I agreed with Diana Moa totally on that. It's about wages as well. There's some interesting research notes this morning. Ben Emmons goes the other way from the whisper number and says, what are we going to do if it's 210 or 220 or 230? How's the market going to react? It's a very smart
Where's
note.
wages in that? Where are wages in that, and what does it mean for this Federal Reserve when they sit around the table together in the middle of December? Still got a lot to go through before we get to the end of the year. We've got payrolls out in about an hour and 5 minutes, and then you've got the CPI report on December 13th, and then the Federal Reserve decision December 14th, and I'll throw out the ECB as well, December 15th, and then take the rest of the year off, right, Lisa? That's how it works.
Does the ECB really matter?
Not for me. I'm going to leave after the 14th.
Just playing around.
Futures down 1/10% from New York City this morning. Good morning to you all. It is Payrolls Friday on Bloomberg Surveillance.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become chief future officers. The cruise industry shut down during COVID. Now, CFO Naftali Holtz has Royal Caribbean full speed ahead.
Our goal is to get back to the balance sheet we had. This business is very resilient.
Watch Chief Future Officer, Wednesday on Bloomberg.